Welcome back, everyone. It is Tuesday, April 11th here in New York City. I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live, second trading session of the week, kicking off in about 30 minutes here. Let's take a look at where the markets are. Futures pointing right now mixed for the Dow and the S&P. You're seeing gains there, flat just barely to the upside for both of those. And the NASDAQ composite, you're seeing that to the downside by about 0.1% right now. We'll round that off to just about 20 points in the red this morning.
Yeah, and the Federal Reserve finds itself in an increasingly tough environment as it looks to fight inflation, navigate slowing job growth, and preserve overall financial stability. The March jobs report offered the latest glimpse into the state of the labor market, while traders are anxiously awaiting tomorrow's inflation data for more clues on the Federal Reserve's path ahead. Let's get over to Yahoo Finance's Jennifer Schonberger. She's sitting down for an exclusive interview with the New York Federal Reserve President, John Williams. Jen, take it away.
Good morning. I am indeed here live at the New York Federal Reserve with the president of the New York Fed and vice chair of the Federal Open Market Committee, John Williams. President Williams, thank you so much for sitting down with me and for having me here at the New York Fed.
Well, it's great to be here and welcome here to the bank.
Thank you so much. I want to kick off the conversation with your reaction to the March jobs report. We saw the non-farm payroll number cool off a bit from those blowout numbers back in January and February. At the same time, temp jobs went down by 11,000 and job openings have fallen to the lowest level in 2 years. While still strong, does it give you any assurance that the job market is starting to come back into balance?
Well, we definitely see some slowing in the demand for labor, as you just pointed out. Job openings have come down gradually, but they're very high still relative to history. Unemployment, of course, is very low at 3.5%, and job growth is still quite strong. And in fact, when you look closely at the data from the past few months, we had unusual weather patterns, and I guess when I look at that, it seems like job growth is actually quite strong still, even in the latest data. So yes, we are seeing some slowing in the demand for labor, but the demand for labor is still very strong. Labor market is still very strong.
How much do you think of this as structural, given some of the trends we've seen from the pandemic?
Well, I think some of it I think is still related to the pandemic, and the labor market and the economy have had to adjust to the shifts in demand and supply that we've seen over the last few years. And I would add to that Russia's war in Ukraine. So a lot of factors have affected the U.S. economy and the labor market. In terms of structural, I think one of the things we are still watching for is a lot of people who retired earlier than usual. Will they come back into the labor force, or is there some change in their decisions that they've made going forward? Other than that, I don't really see that this is really fundamentally being structural, but more just a reflection of the highly unusual patterns we've seen in the economy the last couple of years.
So then, given your assessment of the job market and new developments we've seen with OPEC cutting back on oil production, how does that inform your outlook for inflation?
Well, inflation has started to come down. It peaked for the last year around 7% on the personal consumption expenditures price index that we follow at the Fed. It's down to about 5%, still way above our 2% goal. We're seeing inflation come down mostly now in the commodities and the goods prices, and I think that does reflect some of the pandemic effects, fading. We're seeing supply chains opening up much more globally, so those things are all good to bring down those factors of inflation. We're also seeing some signs that demand for housing is slowing. We're seeing that in the housing data. We're also seeing that in the rent data for the new, rents that people are signing new their new leases on. So we're seeing signs of inflation slowing, but inflation is still very high. And I would just mention that, some of this core services inflation, excluding housing, that hasn't budged yet. So still got our work cut out for us to get inflation back to 2%.
So you've got inflation risk. On the other side, there's still reverberations now from the bank failures last month. So what are you seeing in terms of credit conditions? Any sense of whether credit conditions have tightened further since those bank failures, and whether banks are cutting back or may soon cut back on lending?
Well, this is something I and many others are watching very closely. Right now it's still pretty early days in terms of seeing clear signs of changes in credit conditions and credit availability. I'll be watching that closely to see those signs and then see any broader effects on consumer spending, business spending and other parts of our economy. So right now, you're not seeing any strong signs of those effects happening, but it's something I'm very much watching for. I would say it's in the context of an economy that's actually growing pretty well. First quarter growth, it's not, we don't have the official numbers, but it looks like the first quarter growth is well above 2% at an annual rate. Labor market, as we've talked about, is still growing, is still very strong. So we're starting from a place of a pretty strong beginning to the year. It's just a question of, do credit conditions tighten somewhat, and how much of an effect does that have on the outlook? Still a little uncertain.
So given that, how do you view financial conditions now?
Yeah. So, I think it's important to separate some of the credit availability from banks because the issues we've seen are really in a few banks from broader financial conditions. I mean, we've seen financial conditions tighten since the Fed has been tightening monetary policy. And I would highlight that central banks around the world have been tightening monetary policy. So I think that financial conditions broadly have tightened in the way you'd pretty much expect, given monetary policy moving from very accommodative to now somewhat restrictive.
So then given that, how does that inform your thinking for the policy path and ultimately the peak on the Fed funds rate?
Well, so right now, I think we've gotten monetary policy into a restrictive stance. Underlying inflation is probably in the low 4%. Obviously, we raised the target Fed funds range above that. I think the question for us is to really watch the data. We got a lot of data coming, obviously, on the retail sales and CPI and a lot of other indicators, and see what are we seeing in terms of the trends in demand, both in the economy and in the labor market, and what we're seeing in the inflation data. I go back to our economic projections in March. Clearly, if you look at the median dot, if you will, people expect maybe one more rate increase. I think depending on conditions, we'll see what we need to do. I think really it's going to be a period of also just learning along the way. Are we really getting to the sufficiently restrictive policy to make sure that we bring inflation down to 2%? We need to get that done in the next couple of years, so we need to get policy right for that.
How restrictive would you say we are right now?
Well, I would say we're somewhat restrictive. I mean, I would get out my thesaurus maybe and come up with a more creative word, but I think somewhat restrictive. My view of kind of the longer run neutral real interest rate is about 0.5 percentage point. So I think we're somewhat above that. So the real question to me is, we've gotten to restrictive. What's it going to take to be sufficiently restrictive? Do we need to do somewhat more to get there? And obviously be driven by kind of the data and the outlook.
Did your estimate for the peak on the Fed funds rate change at all given the bank failures?
Well, I think that we all have to take into account a lot of different factors in thinking about the economic outlook and the risks to the outlook. And we've seen the data, come in pretty consistently strong. At the same time, and inflation has been very high. At the same time, I think the economy is going to grow at a pretty modest rate this year. That hasn't fundamentally changed. So I do think that the bank failures add to uncertainty about the outlook, and we'll have to take what actually happens into account. But fundamentally, my view is we have an economy that will grow modestly this year. Unemployment will probably edge up over the next year somewhat. Inflation will come down.
Mm-hmm. So then, is it fair to say that you still see, given the SEP that you brought up, the Fed funds rate peaking around the range of 5 to 5.25, and then pausing?
Well, that's a reasonable starting place. I mean, that's the median we saw from my colleagues. Again, have to be driven by the data. I will say that one thing that paying attention to is the financial or the credit conditions, but also really do we really see signs of this underlying inflation coming down?
So let's say we get to the fall. If you do intend to stick with 5 to 5.25 and then pause, let's say we get to the fall and inflation's still high, it's not coming down. What is the prospect of needing to resume rate hikes after you pause? Would that be on the table?
Absolutely. We need to do what we need to do in order to make sure we bring inflation down to 2% over the next few years. So if inflation ends up being higher than I expect, or stickier, as you said, then we'll have to adjust policy appropriately. We've been doing that. We've been learning along the way over the past year and a half. Clearly, the peak funds rate and the path for the funds rate have changed as the data have informed kind of the views of where inflation and employment are likely to be, and we'll just just need to stay in that data-dependent mode and really focused on achieving our maximum employment and price stability goals.
So would you, the market right now is pricing in rate cuts later this year. I know that's not in your projections, but from what you're saying and how you're characterizing things, would you say it's safe to say there's more upside risk to the path for Fed funds rate versus cuts?
Well, I think it really depends on what happens in the data. When I look at market projections or path for the federal funds rate, I think a lot of people in the private sector have somewhat slower economic growth or maybe even a recession in their outlook. They also, a lot of them have inflation coming down much faster. So it could be that's part of the reason that people expect the funds rate to come down more quickly than we have in our projections. It's just a different view on how the economy is going to evolve. Again, we need to be data dependent. If inflation comes down faster than we expect, that would be great news, and that would obviously inform the path for policy. So I don't see that difference between how maybe the markets or commentators expect the funds rate to come down faster than our projections as a problem. It's, I think, more of a we'll see how the economy evolves, and obviously we'll just be focused on achieving our goals.
What would it take for you to cut rates? Does it have to be that severe recession scenario, or if you feel like credit conditions end up tightening more than perhaps thought, are you able to sort of snip a bit off the top and still have real positive rates, if you will, still be restrictive, adjusting for inflation?
Well, I think the real issue is if inflation comes down, we're going to need eventually, not soon, if inflation comes down, we'll need to lower the interest rates, because otherwise real or inflation adjusted interest rates will go up. So if you look at the projections in the economic projections that we put out in March, we all, or at least the median dot, has the funds rate going down in next year and the year after. And I think that's really primarily driven by the fact that inflation is coming down and we'll be moving monetary policy to a more normal stance. So I think that's an important driver of inflation, of interest rates eventually coming down. Obviously, other factors, how the economy is doing and how this all fits together, would be relevant as well.
I want to ask you about risks to the economy. A lot of folks are saying commercial real estate could be the next shoe to drop. Of course, we heard that back in 2009 after the financial crisis didn't come to fruition. Nevertheless, what are you seeing? You're here in New York on commercial real estate.
Well, clearly commercial real estate, especially office space, there's a lot of open questions about what's going to happen there. With a hybrid model and fully remote work, companies are using office space differently. The demand for office space will be changing. I think that does affect the market price of a lot of those buildings, both here in New York, but in other big cities. So that's clearly something that will have to be resolved over time. It's not something that happens on one day. And there, like you mentioned, in the past, we've seen typically the borrowers and the lenders work things out in a way that's not disruptive. But that said, it's definitely something very much on my radar, both in terms of the New York City economy, but also broader conditions.
On credit conditions, I know you say you're not seeing too much of a tightening right there. Of course, we'll see what happens as time plays out. But given these bank failures and the question mark of the magnitude of that, how much does that raise the odds for a recession?
Well, I think that, again, we're in a situation where even before this, growth was going to be relatively modest. And so, it's hard to predict recessions. If you ask economists, they like to predict them, but they're not, the track record's not very good on that. I do think it's a factor that could influence confidence, consumer and business confidence, and it could affect the availability of credit. So we'll have to watch that. It clearly could be a negative shock to the economy and cause the economy to slow further. But right now, we're not seeing those effects, and actually the banking system is really stabilized, and so it's pretty much focused on the two banks that failed. So I guess right now I'm not thinking that it would be such a big negative on the outlook, but we're gonna have to watch the data carefully.
Mm-hmm. Yeah. To your point, we are going to see slower growth, you project this year, maybe not a recession, but slower growth. If inflation remains persistent and interest rates need to remain high as a result of that, what is the prospect for a stagflation scenario?
Well, I really don't see that. One of the things we've actually seen in the labor market, and we started with the labor market, so I'll come back to that, is as labor demand has come down, we've seen the job openings data come down, we've seen wage growth come down, but we haven't seen unemployment go up, at least so far. So I think if we can get this nice balance of supply and demand demand in the economy, where demand comes back in a way consistent with supply, we don't need to have such a negative effect on the economy, and at the same time reduce the inflationary pressures. So I think we've got some things that we've already talked about that are helping us bring inflation down. Some of the pandemic effects and supply chain issues are now fading, and it's really a matter of just getting supply and demand back into balance. Demand is still far exceeding supply, and that's what monetary policy can do, is get that balance.
So it sounds like you're not too worried at this point about ripple effects from the bank failures and credit tightening. I know you said we're going to watch and see, but I'm curious if that could have any implications for your quantitative tightening program if we were to see credit conditions tighten further.
Well, I really think that the shrinking of our balance sheet, the QT, as you mentioned, is obviously something that has been going on for quite some time. It's going very smoothly. I don't see that as the main area of focus for thinking about monetary policy. Really, if the primary instrument of monetary policy is the federal funds target, and we can adjust what we do with that to best achieve our goals. Again, I think this bringing the size of our balance sheet down is working really well. It's not something that I would see as something we would need to adjust anytime soon.
Given your outlook for inflation and that you're not seeing too many signs right now of the credit tightening impacting the economy, how quickly do you think you need to move to get to the peak on the Fed funds rate? Do you need to move really fast, or do you want to give it some time to see how things settle out and maybe do it later in the summer? What you thinking?
Again, we'll be driven by, we're going to learn a lot from the data we get. We'll figure that out. We'll have look at all the briefing books and have that discussion at the meeting and at a future meeting. So we'll figure that out as we can to best achieve our goals. I mean, clearly we're in a situation that, at least according to our current projections, we're not that far from that peak rate. So it's not something that, like a year ago, where the problem was we understood that the peak rate was quite a ways off. We didn't know exactly what it was, but we needed to move quickly to get that. We're not in that situation right now. So I think we can adjust as needed, and obviously, and continue to watch the data and continue to be data dependent.
So you say we're not in that situation, meaning you could wait potentially to go another 25 basis points, or better to go in May? I know your data is pending. I know.
we'll see. I don't think it wouldn't be a problem to do one or the other. I think that the main point I'm making is we just need to get the analysis of data, clearly make a clear decision and move forward from that. I will go back to the fact that right now the labor market remains out of balance. Demand is still much stronger than supply. Inflation is still very high. So we have to always keep that in mind. That's where we're starting from, and then think about what are the various risks and different things that can happen in the future.
President Williams, thank you so much for your insight. I so appreciate it. Hope to speak with you again soon.
Great, thank you.
Back to you.
All right, thanks so much to our own Jennifer Schonberger. Great work there, along with the New York Fed President, John Williams, everyone. Switching gears here a bit, Bitcoin leading a crypto rally this morning. Let's check in on the digital currency market. Taking a look first here at Bitcoin, BTC USD. You'll see over the past 5 days, holding on to gains of about 7.2%. But here is a key marker that we've crossed the threshold on, a perhaps psychological marker, but it does have some significance here, getting back up above 30,000. And as of right now, sustaining above that level. We'll see if we hold on to that. You'll, of course, recognize that that is one of the highest levels that we have seen essentially in over the past 9 months here. This is a 52-week look here. And, of course, the last time that we were above 30,000, you can go all the way back to May of 2022. And so with all of that in mind, of course, we've had a few things take place most recently that's reinserted some confidence year to date within Bitcoin, but most notably that coming early in March or midway early through March, where you saw a lot of the banking turmoil really thrust so much attention towards the cryptocurrency landscape. Bitcoin, one of the beneficiaries there. I'll pull up some of the other major cryptocurrencies that have risen as well in tandem here. Let's take a look at Ether or Ethereum. You're seeing that up on the day by about 3.25%. That has not quite gotten back above 2,000 here, but we'll put this on a year-to-date view for you as well, just to see some of that activity that we've been also monitoring throughout the cryptocurrency landscape. Ethereum, you're seeing that mid-March move take that higher and to one of the year-to-date highs that we've seen as well. So year-to-date highs for Ethereum as well as for BTC, USD. Also want to take a look at the Binance coin here and just see exactly how that's doing. Year to date, that is up by about 35%. And here today, up by about 5.5% or 5.4% right now. Julie?
I mean, it's all relative when we're looking at Bitcoin, though. If you look at the chart, going back a little further, it's the first time that we've hit 30,000 in 2003. But if you look at a longer term chart, we're still way below where we were the previous highs. But, bulls will say we'll reattain it. We'll see. Well, in the aftermath of the collapse of crypto exchange FTX and the downfall of Sam Bankman-Fried, a trove of internal messages has now been added to a court filing and released to the public. SBF, along with executives from FTX and Alameda, reportedly joked around via Slack messages, as one does, about the possibility of coming into compliance with normal financial controls. According to the filing, SBF describes Alameda as, quote, hilariously beyond any threshold of any auditor being able to even get partially through an audit. And he added that FTX would, quote, sometimes find $50 million of assets lying around that we lost track of. Such is life. Indeed, such is life. So you can read all about this in today's morning brief written by Miles Ludlam. That's up now on the Yahoo Finance homepage. And the collapse of FTX has indeed shined a light on the need for stricter crypto regulations. For more on this, we welcome in Brian Doherty, Bitcoin Association for BSV Global Public Policy Director. So obviously there is the alleged fraud that happened at the company, but then there's also the idea that it was so sort of opaque that an auditor wouldn't even be able to get in there, right? And that no auditor was, in fact, maybe required by regulators. So what do these latest revelations tell us, if anything, that we didn't know about the need for regulation, Brian?
Yeah, thank you for having me on. I mean, from my perspective, there appears to be little question in my mind that FTX suffered a critical failure at leadership at best and criminal activity at worst. I find it interesting because the primary objective of blockchain as a ledger is to create an infrastructure that fosters trust and transparency in record keeping. And I believe this is a prime example of the stark contrast between the speculative nature of cryptocurrencies and the true value offered by blockchain technology. And by harnessing the power of blockchain for its transparency and utility, it can create or act as the backbone for any trading platform, whether they involve cryptocurrencies or traditional stocks. And this approach really paves the way for real-time auditable settlement of an exchange layer, which guarantees reliability, assurance, and prevents the misuse of assets that either don't exist or aren't under the controls of those who are attempting to take advantage of previous gaps in the fintech sector.
Even with regulation that has been asked for by the crypto landscape so that they know exactly what kind of boundaries to operate within, even with that on the table for discussion, there's still so much question about what utilization will even look like in the future. And perhaps that regulation will drive the utilization picture there. But how do we eventually kind of gauge what the appetite for the end consumer and for the regulatory framework that is to come, what the appetite would be for this to be a leading currency or one of many leading currencies in the U.S., especially when other countries are stepping away from the U.S. dollar?
Yeah, that's a great question. I think the U.S. is really involved. They're very active on the Hill right now in looking at the best regulatory framework, whether that's allowing the SEC to continue on their quest or potentially the CFTC or a new regulatory framework. From my perspective, I really believe that, the laws that we already have in place, such as the Howey test, to really allow us to kind of distinctly remove some of the froth or bad actors from, this sector. And, just the application of even the Howey test would, clean up a lot of, the nefarious activity that's occurring. And I think until we have a sound, understanding of really the legality and the regulatory outlook of these, that it is going to be difficult for cryptocurrency or blockchain in general to kind of solidify itself.
Okay, and so one of the full screens that we were just showing a moment ago as well, it really raises this question of what energy usage with cryptocurrency and with any kind of significant type of infrastructural play that cryptocurrency would require, what that energy correlation looks like, and if we are even on the path towards realizing what that actual footprint, what the detriment of that footprint could be, or even the benefits on the other side of that. How are you evaluating this?
Yeah, so I've spent a great deal of time looking into the energy consumption and utilization of proof of work. I believe there's a great misunderstanding really about mining, Bitcoin mining, proof of work mining, in the sense of, we judge everything currently through an economic model that really doesn't justify technology. Most technology is judged by throughput. And so when you see competing, proof of work protocols, that are working to scale, it's interesting that, scalability is really equal to sustainability. So the more that these technologies scale, the more sustainable they are. And what we've seen is, by increasing that throughput of blockchain transactions, it lowers the actual carbon footprint per transaction. And so as we kind of go through this sandbox of testing out these technologies and scaling them, we will see clear winners and losers. And unfortunately, from the perspective of utilizing this technology, it has to scale. So if something is only providing 7 transactions per second, even on our best day, that would not serve as a global currency at all. So we really need to focus on how to scale this technology. I think proof of work provides the information security that we desperately need in our systems. So I really think it's just a misunderstanding of how to scale blockchain, how to scale Bitcoin, and that footprint actually could displace, legacy footprints that we currently have in whether it's the financial industry, whether it's cloud technology. From my perspective, blockchain provides much more than just a tradable asset. It really starts to play into the key infrastructure and security of data and data integrity.
Not there yet, but maybe eventually we will be. Brian Doherty, thank you so much. Bitcoin Association for BSV Global Public Policy Director. Appreciate your time this morning.
Thank you so much.
Coming up, we've got a decline in shares of Tilray after it reported a $1.2 billion loss in the third quarter and made a big acquisition. We've got the opening bell on Wall Street and your movers coming up. we're coming up on the opening bell on Wall Street in just a few moments. And as you noted earlier, Brad, we got a mixed picture here going into the session. So not a lot of big moves. It feels like we are in sort of that take a breath period before the CPI report tomorrow, before the big banks report later in the week. And maybe people are kind of sitting on their hands as they wait for more information.
Yeah, just waiting for some type of conviction to enter in, but that conviction is really just going to come on the back of data that would further show perhaps what the inclination of the Fed is, as well as the commentary from those businesses before.
Yeah, indeed. And there we've got the opening bell here on Wall Street. And in terms of commentary from the Fed, we did just get some, of course, from the president of the New York Federal Reserve Bank, interviewed exclusively by Jennifer Schonberger. And he talked about that, the challenges that the Fed is facing right now, that the inflation has come down, but it is still above where the Fed wants it to be, and that inflation has been persistent, right? That it has been stubbornly persistent. That's my word, perhaps not his, but that, obviously it is still a challenge for the central bank, even in the face of what we've seen from the financial system as well. He did talk about that he believes we are, for now we've gotten the banking situation under control. So there's the mixed picture here as we open up here this morning. Brad Smith, of course, is over at the Interactive. Brad, what do we got going on this morning?
Yeah, our viewers already have in the lower corner of their screen a look at the major averages here, where we did indeed open up mixed. So I wanted to zoom ahead, Xenon reference there, ahead to some of the sector activity that we're seeing here out of the gate here today. And that's where you'll get a look at this flat S&P 500 overall in aggregate. However, more advancers than decliners right now. The decliners, though, coming in the form of utilities and technology. Over the course of today's session, it's been down by about 0.4%. We are, of course, just kicking off that session, though, and real estate just entering into the red. However, we are being led this morning by energy, XLE. You're seeing that up by about 0.5%. And then additionally, taking a look at XLB, yeah, I saw that higher earlier as well. Materials, that continuing to catch a bit here. That's up by about 0.5% right now. Let's take a look at the NASDAQ composite, the NASDAQ 100 at least. And as that calibrates, some of the mega cap tech stocks seeing red on the day out of the gate here. Microsoft down by about 1.7%. Apple also flat, just barely to the downside by about 0.1%. Fractional declines for Alphabet, Google, whatever you're calling them, call them down. Amazon also lower by about 1.9%. A little bit of a bounce today. We saw Tesla move lower yesterday. Here today, it's up by about 1.3% to kick things off here. And we're going to dive more into some of those tech names a little bit later on. And then we'll just ride out with a look at the Dow 30. Those components here on the day, relatively mixed. We'll put that equal so you get a good view of the relative, almost a split. More gainers than decliners, though, right now, Julie.
Yeah, one difference from yesterday, too, is yesterday we saw bond yields going up. That's not been good lately for tech stocks. But today, they're not doing much of anything either. So that's something also that is not necessarily providing the stumbling block that we saw it provide in yesterday's session for big tech. Yeah. Let's talk about some other movers. We've got CarMax. That stock is moving higher by almost 6% after topping earnings estimates. Revenue, though, falling short of analyst expectations. The company did reiterate its long-term financial targets. It is planning new store growth to 5 locations. A couple of interesting things here. The magnitude of the beat, pretty impressive here, 44 cents a share versus the 20 cents estimated. The company did say the average retail selling price of a used car fell by 9.3%. However, in the earnings release, they highlighted vehicle affordability as an issue, Brad.
Yeah, they did talk about the vehicle affordability. They talked about how much of the vehicles they're continuing to buy. They bought 262,000 vehicles from consumers and dealers. That was actually down versus last year by about 22.5%. And then additionally, talking about the deliberate steps to really prioritize profitability. You heard from Bill Nash, the president and chief executive officer, saying that they tried to further improve the most customer-centric omni-channel experience in the industry, an industry that certainly has been battered. We were taking a look at some of the industry competitors. Of course, Carvana was Yahoo Finance's laggard of the year last year, the worst performer there, and ultimately has seen a bit of a bounce, but a bounce off of some pretty dismal activity that we saw during 2022. Here today, though, you're seeing it up by about 9% here. But in this report, I mean, net revenues down 25%. You saw retail used unit sales decline 12.6% in the fourth quarter, and comp store used unit sales declined 14%. So there was a lot of bad that was within this report, but it's perhaps not as bad as it could have been. And I think the prioritization and the continued talking about the profitability and what they can do, at least in this immediate term, to pull some of those levers, that is certainly being listened to by the investor community right now.
Yeah, one more thing I just want to highlight here, and that's the financing arm of CarMax, right? That is when you buy a car and you finance that purchase. And this is important not just for CarMax, but also does it give a little preview of what we might hear from some of the banks? Not the same, obviously their loan portfolios is much more diverse than that of CarMax, but still something to take note of here. The net interest margin percentage declining at CarMax. That's something perhaps we can expect from the banks as well. The company also talking about increasing its loan loss provisions. The loan loss allowance, 3.02% of its managed receivables, which is an increase from 2.9%. So directionally, anybody who has loans on their balance sheet, right, you're going to expect that we should pay attention to net interest margin and should pay attention to the allowance or loan loss provisioning. In other words, how much do companies put aside for potential defaults or non-payment of loans? Right. That's something that I think not just this earnings season, but really throughout the year is going to get more and more attention.
I was reading through this report and I was like, I knew Julie's going to bring that up for sure. I don't even need to worry about that.
There you go.
Yes, spot on.
Let's talk about Moderna too. Those shares are taking a hit after the company said the late-stage trial of its experimental flu vaccine had not enrolled enough cases to determine efficacy. The shares are down 3.4%. Now, Moderna is having an investor day today focused on its various vaccine developments. And it had a lot of big, impressive, exciting things to talk about. Vaccines for all kinds of stuff. Vaccines for cancer, vaccines for heart disease, vaccines for Lyme disease, a norovirus, right? But those are in development in the future. This is something that is currently in development, this flu vaccine, and it just doesn't have the data it needs yet.
Yeah, the first influenza candidate, mRNA 1010, they said didn't accrue sufficient cases at the interim efficacy analysis to declare early success here, and that's certainly rattling the shares here this morning. But when you're even talking about all of the different vaccines that they want to put forward here, it's really them creating or at least positioning the story around messenger RNA as a platform where you can have reinsertable or adjustable code that essentially, and that would be kind of the most analogous type of situation that they could put forward that everybody would understand. This kind of Google Doc that you could essentially edit, if you will, and swap in the code or swap in the verbiage that would be relevant for one type of virus or disease or illness versus another. And so that messenger RNA essentially being a platform by which they can build on top of and hopefully prove efficacy through so many of the other vaccines and solutions that they put forward from here.
But obviously not as easy as a Google Doc, or they would have done it.
Well, Google Doc's pretty easy
They're still working
too.
on it.
Yeah,
exactly.
Also, let's talk about JP Morgan initiating coverage of Upstart here on the day. They started with an underweight rating, warning shares of the AI lending platform could struggle as the environment for loans worsens. And I mean, this should come as no surprise to anybody who's been tracking Upstart right now, even though shares right now are kind of shrugging this off or getting the dirt off their shoulder, as Jay-Z would say. This is a company that had talked about in their most recent earnings period a reduction in lending volume. It's also a company that had to take the unfortunate step of headcount reduction. They cut that by about 20% of their staff. That was discussed in the most recent earnings period. And at least according to JP Morgan, they believe that the environment for loans is going to continue to worsen. Going to be interesting to see how that impacts their business, but also for Upstart, most notably here, a company that has relied on AI or at least built in AI to a certain extent for some of their lending functions and decisions as well.
Yeah, some of the commentary from this is quite interesting and almost echoes a little bit what we were just talking about with CarMax. The JP Morgan analyst Reginald Smith saying, recently defaults have increased. Institutional demand for its riskier unsecured consumer loans has waned, and losses on the company's held for investment portfolio have swelled. it's not a great picture, right? At the same time, they say, shockingly, the shares are up year to date. And they're up today, even in the face of this underweight rating. Yeah. They like the long-term potential, but they said this is going to be an extremely cyclical business. So I guess buyer beware is the message here from JP Morgan today.
Yeah, indeed. All right. They've initiated coverage there. We'll see what Upstart and shares do from here. We're also watching shares of, that company on your screen, TLRY. Do they have an alibi? We'll find out. But they're sinking right now after the cannabis company announced it will acquire Hexo in a $56 million all-stock deal, despite reporting a $1.2 billion loss in the third quarter. We're going to speak with Cowen's Vivian Azer for a full pulse check on the industry later on in the show. Coming up, why one analyst says that Meta is winning the battle versus Amazon. Yeah, our own Brian Sozzi has the breakdown here next. Battle of the tech giants. Despite both Amazon and Meta taking a hit from the tech downturn in 2022, Meta shares, they're up over 70% year to date in 2023, where Amazon is only up 20%. Yahoo Finance's executive editor, Brian Sozzi, here to break it all down for us. All right, Casual Soz, what do we know?
Yeah, casual indeed. Well, slow day like this, I would say, outside of Jen's awesome interview with John Williams. Always a good day to mine for certain stock stories, and this one definitely caught my attention. Looking at Amazon stock, up about 23% year to date, according to Yahoo Finance data. Meta stock up over 80%, and a good note out of Jefferies' Brent Thill, perhaps explaining why you're starting to see, or why you continue to see this relative disparity. Let's keep in mind, both these companies, by my estimation, have laid off or fired over 40,000 human beings over the past 6 months. That should improve profit margins. Both have cash-rich balance sheets. That has been good or rewarded in the market so far year to date, as you've seen investors go back to beating up tech trades. But if you look at Amazon, according to Thill, you're now seeing sales estimates for Amazon Web Services. That is a business that makes up the majority of Amazon's operating profits. Sales estimates down about 12% compared to February 2022 and down 5% compared to the start of the year. Operating margin estimates as well, as you can see on the chart, they are really starting to fall off the cliff for Amazon Web Services. Wrap this all up, and you're really getting, I think, a lot of investor concern about the pace of growth in Amazon Web Services as a result of economic uncertainty, you name it. And considering this is the large majority, the largest driver of the company's operating profits, if these estimates are declining, it's going to weigh on the stock. And then, of course, Meta just doesn't have this cloud services business.
It's interesting here when you look at his rating. It's still a buy rating.
He loves
right?
Amazon.
So it's not it says he posits this will delay the company's margin recovery, but he still says people should buy the stock.
Right. I think Brent does not see an operating margin recovery for Amazon Web Services until 2024. And I think his argument has long been, we've talked to him a lot about this, the sum of the parts on Amazon is not reflected in the stock price. So that is something to keep in mind as well. But at least for this call, ahead of Amazon earnings, it is suggesting that Amazon Web Services had another perhaps disappointing quarter, and maybe Amazon's outlook once again is not as rosy as a lot of people on the street think.
Yeah, I think two words are going to continue to come up, or at least transfer over from last earnings season too: deal scrutiny. We heard that for a lot of cloud or ERP companies. Amazon certainly in those throes as well here. Brian Sazzi, thanks so much for breaking that down for us. All right, guys, it's time now for our chart of the day. The Adobe Digital Price Index showing that online prices are seeing a slight decline, falling by almost 2% in March. That slight fall was driven by steep drops in discretionary spending, products like electronics and toys. And among categories with persistent inflation, like groceries and personal care, price increases have slowed in recent months. This comes ahead of tomorrow's CPI data, which tracks the rate of change in inflation and will provide more insights into how the U.S. economy is faring.
What stands out to me from that chart, what I love about that chart, if we can bring it back up, is for how long online prices were falling, right? That the whole tech economy, and in particular online shopping, was a deflationary impulse, mainly because of Amazon, right? Because Amazon, one of Amazon's main competitive advantages with scale and being offered, was the Walmart effect, right? Being able to offer things at a lower price. And then you see that abrupt switch in the midst of the pandemic that is now reversing itself once again. And to me, it's just a fascinating story. We got used to paying less online for so long. And that's just not happening anymore, in part because we're not buying as much stuff, period.
Sure.
Right? Which is why we're seeing that sort of goods inflation, that dynamic start to shift, and what we're buying shifting as well.
Right. Electronics, home goods, toys, some of the categories that have suffered.
The big ticket stuff, too. So that's why also it brings down some of the numbers.
Right. And to your point, I mean, we had become so used to doing our comparison shopping online because it was that much easier. Didn't have to go to the mall, didn't have to walk in all of these stores, didn't have to fill up the tank of gas to go to the store. And so there were all of these benefits, as well as the couponing and companies that came about and even went public and started traded as a result of that throw of individual consumers out there and businesses that had relied on those discounts. Companies like Retail Me Not that were able to just, yeah, remember that? Just flow the coupons out there, folks. However, yeah, coupons can ultimately come back and hit a company, especially as they're trying to maintain some of those profit margins right now. And so there is, even as companies are prioritizing the profit margin, less of the deals, more of the prioritization from the company perspective and retailer perspective to try and get more full price realization. However, this reversal here, perhaps for consumers, something to kind of get a sigh of relief about as of right now.
Yes, we'll see. We'll find out more tomorrow morning in those CPI numbers.
Indeed. Guys, coming up, why our next guest says falling inflation data won't make the Fed less hawkish. We're going to speak with Seven's Report's Tom Essay. That's next.
Well, we could be seeing signs that the rate of inflation is slowing, but where can investors expect the Fed to go from here? Here's what New York Fed President John Williams had to say about rates and policy in a Yahoo Finance exclusive with our Jen Schomburger earlier today.
We need to do what we need to do in order to make sure we bring the inflation down to 2% over the next few years. So if inflation ends up being higher than I expect, or stickier, as you said, then we'll have to adjust policy appropriately. I think we can adjust as needed, and obviously, and continue to watch the data and continue to be data dependent.
Data dependent, we know what that is. Joining us now, Tom Essay, Sevens Report Research founder. So, Tom, expressing maybe some optimism there that inflation is going to come down, but at the same time acknowledging it hasn't as much as we would like. What does all of this mean for the Federal Reserve? What's your takeaway?
Good morning, guys. Thank you very much for having me on. Listen, inflation is just still way too high, right? I mean, we're all fixated on the rate of change, and that does matter. But tomorrow we're going to see both headline and core inflation print with a 5% handle on it. Right. I mean, 2-3 years ago, that would be laughable to us to see something that high, yet we may be excited. Going forward, though, the inflation conversation is going to switch a bit. Before, it's been all about headline inflation, right, which is like 6, 7, 8, 9%. Now it's going to be about core inflation. So that's what I want everybody to watch tomorrow. If it comes in under 5.5%, that's a positive. If it comes in over, well, the Fed still has more work to do.
I mean, it seems like they know that they still have more work to do if they're using their benchmark interest rate as the kind of precursor for what their decision could be and what the discussion will entail. But it could come down to, exactly what the tenor in that discussion is among the voting members of the FOMC. Do you believe that there will be more who look at the data that's come out, whether that be on the employment front, and say, we've got our backstop that's already in place. We can continue moving forward right now?
I think the Fed will be more hawkish than the market is currently expecting. We have to remember something, right? If we look at year-end Fed funds estimates, it's like 4 to 4.25%. So the market is pricing in numerous rate cuts, not hikes, rate cuts before year-end. So I think that the people on the Fed are very aware of what happened in the 1970s, and I think they're very afraid of it, and they should be, because back then the Fed did this sort of schizophrenic jump all over the place, cut, hike, cut, hike, cut, hike, and it really crippled the economy for years and years. I think they're afraid of that. I think the Fed is more hawkish than the market currently expects.
And so let's bring it all back to the market, right, and to what people should be doing in this environment. It seems like today people aren't doing much of anything because they're waiting for more information. We're going to get a lot more information this week. We're going to get CPI tomorrow. We're going to get bank earnings later in the week. How should people be positioning themselves?
We think probably the most clear trend in the markets right now is slowing growth, right? And it's a question of, hey, do we get a recession or do we not? But what we're not seeing a lot of argument is, will the economy slow or not? So I think that's what people should really be prepared for. Inflation will decline over time. We know that. It's just a question of how fast. But we do know that growth is slowing already, and that is going to continue. So we think stay defensive in your tactical allocations, utilities, consumer staples, healthcare, even the super cap tech names that did well over the past 2 weeks. We think that's a good place to hide for the next couple months.
For investors that are looking to trade off of any type of commentary that they see show up within the bank earnings this week, what should they be listening most closely for to best position themselves, even around the anticipation of what a Fed decision may look like? What are some of the key areas that they can keep an eye on within bank earnings in order to position their portfolio?
So I think loan demand is the key, right? So very quietly, the last 2 weeks of March saw the biggest decline in commercial loan demand on record, right? Of course, that relates back to what happened with SVB and SBNY and other regional banks. If loan demand falls through the floor, that's not just bad for bank earnings, which obviously is very bad for bank earnings. It's also bad for the economy, right? We still live on a leveraged and debt financed economy. If all of a sudden the banks are closing the doors to lending, like we saw coming out of the financial crisis, that's a new economic headwind. It only strengthens the case that the economy is going to slow.
So, looking then sort of beyond this near-term data and looking into later in the year, do you think that there is going to be more of a realization in the markets that things are going to turn for the worse?
I think that the market has a very optimistic view right now, right? And I think that sure, can you get an inside straight in poker? Absolutely. Is that the way you bet? No. So I think that really investors should think about, hey, the outlook may not be as good as 4,100 in the S&P 500 implies, and are we prepared for a bit of temporary disappointment? No, I'm not, Mike Wilson. I don't think that we're about to go down 20 or 30% in the market, but I do think that the outlook may not be as rosy in the next 3 to 6 months as the market may be pricing in right now.
Do you believe that that means that the economy is going to be in more of a mild recession or something that we haven't discussed yet, or a harder landing than we've anticipated?
I'm colored by my experience. I've been through similar episodes like this in 1999, 2000, and then 07 and 08. And in both cases, at the beginning, people were saying it's not going to be so bad, mild recession, and they were wrong both times. I don't think what we're looking at is an 07 or an 08, but I do think the economy could slow more than people expect, especially if the jobs numbers really start to fall.
Tom, good to see you. Tom Essay, Sevens Report Research founder. Thank you. Coming up, big banks are set to ramp up earnings season Friday, as we've been discussing. Why analysts are more pessimistic this quarter, not just for the banks, but for everything. We'll be right back. Welcome back to Yahoo Finance Live. I'm Julie Hyman. That's Brad Smith. Let's take a look at the market action here, almost 30 minutes into the session. And we're still not moving very much. As we've been talking about, people are waiting for CPI data tomorrow. They're waiting for big bank earnings to come later in the week. The Dow in particular not moving much. The Nasdaq's down a little bit more, about 0.25%. And the S&P 500 is also little change here. So let's go back on over to our heat maps and see exactly what's going on. I'm going to start with the sectors here, which we looked at the bell. And really, it's tech that is a little bit of a drag. You've got materials and healthcare and financials to the upside, but Not seeing a lot of movement here. We've been talking about the cryptocurrencies there. There's a little bit more movement as we see Bitcoin rising above 30,000. That's the first time that has happened thus far in 2023. And that 7% move upward that we're seeing today. The crypto stocks are also catching a big bid today. And a lot of them are on our trending ticker page as well on yahoofinance.com. In particular, the likes of Marathon Digital on that list here today. A lot of people checking on that. Coinbase up some 7%, Riot Blockchain up about 11% as well. So that's sort of the hotness in the tickers here today, even if overall, Brad, we are not seeing a lot of movement in the indices.
All right, we're going to keep close tabs on it, folks. We're 31 minutes into trade, a lot of session left here. But earnings season, that is set to kick off this week, and Goldman Sachs is predicting it could be one of the worst quarters since the pandemic. The sentiment on Wall Street is overall bearish, with analysts predicting that the season could end in an earnings recession. What that means, with Yahoo Finance's Miles Udland, who joins us now to explain this more. So, Miles, what does an earnings recession look like from the perspective of Goldman?
Well, when you look at the data on an earnings recession, since we don't have to wait for the NBER to call it, you can say 2 consecutive quarters of earnings going down year over year brings you into an earnings recession. And I think technically you would say we are in one now, or rather it has already happened because we are about to have first quarter earnings results roll in. And of course, we are already in the second quarter. So FactSet data shows a 6.8% likely, a 6.8% drop in year over year earnings during the first quarter. That comes after a 4.6% drop in the fourth quarter of last year and an expected 4.6% drop in the second quarter of this year. So we're looking at 3 straight quarters of earnings going down year over year. Obviously, we are lapping some tough comps, and really the question with all this stuff becomes, one, have we priced in enough? Barclays, we can get into this chart in a bit, is suggesting we have not priced in enough earnings regression, let's say. But I would argue that what we saw in the stock market last year was getting ready for what we're seeing in the results now. But that's sort of that's why they have a market. To have that debate.
That's why they have the market.
Right. And we figure out what the hotness is in the market every day.
Yes, I know. I don't know what to say there. Hotness is the word that came
Close
to my
enough. Hey, it's fine.
As we like to say, though, when you look at earnings, like companies beat estimates by and large, right? So maybe we're not going to get that 6.8% drop, but it's unlikely that we would see enough of a beat that you would erase that decline entirely.
Well, so what's interesting about that dynamic is you can, this is the top-down estimate of, macro strategists who look at the S&P. They say, what is the S&P 500 going to earn on a per-share basis, divided by 500. But on the individual company level, you're right. The point of management of the earnings number is to cut it aggressively as you go. You go to an investor day, which Sazi always loves to talk about. It's like, what do you do at an investor day? You socialize bad numbers are coming. Then when the bad numbers come, you beat them by a penny, so it actually turns into a good number. So part of what I think FactSet's data, and really what strategists are trying to figure out now, is how low do we have to go to find the level at which companies will actually report this? So there's kind of a 2-step dance here, and then you get into the actual fund manager side of it. I think people who are betting on a bunch of individual stocks will say, well, I already know that's going to happen. So I've already written these down. So my question is, to your point, Julie, what does this guidance look like? How do they manage and massage that kind of
phenomenon? Well, and FactSet has data on the guidance too.
Yeah.
And the guidance is not good. There have been a lot of cuts, which might mean it sets us up for a good earnings season.
Yeah, so we've seen, I think the number's 106 companies in the S&P 500 cut their guidance so far this year. Usually you have closer to 75. So cutting guidance is not an unpopular thing to do. There's, people take business school classes on how, and I think they teach this, they take this offline, but how you manage the number around the way you speak to the market. And so, I think the thing with earnings season is, one, it's sort of a weird construction. It's just companies reporting numbers. It's not actually fun, but we think it's fun here. And two, because there's more popular narratives around this earnings period, management teams have become very adept at finding ways to always frame it as a positive. But I think you kind of look at the numbers we're heading into this year, and it's going to be hard to say that corporate earnings are up and to the right.
Yeah, I mean, look, I think it's fun. It's like a head in front of fire hose type of situation 4 times a year. And we get it time and time again.
That's right. And if you're not excited about this, then you're not in the right business.
There you go.
Plenty of other news out there,
Very good.
folks.
That's a very good point.
There you go.
All right, everything on the business of sandbagging, it sounds like.
That's right.
Miles Sutherland, thanks so much for breaking
My
that
handicap's
down.
up to date, though. Don't worry about that. Don't worry about that.
And everyone, coming up, why our next guest says that we are expecting one more rate hike to come and cuts to hold off until 2024. We're going to speak with BMO's Jennifer Lee next. A closely watched government measure of inflation is expected this week, turning the attention back on the Fed's potential and their next move with interest rates. Yahoo Finance spoke with New York Fed President John Williams earlier today on what it will take for rates to come down, and this is what he had to share.
So if you look at the projections in the economic projections that we put out in March, we all, or at least the median dot, has the funds rate going down in next year and the year after. And I think that's really primarily driven by the fact that inflation is coming down and we'll be moving monetary policy to a more normal stance. So I think that's an important driver of inflation, of interest rates eventually coming down. Obviously, other factors, how the economy is doing and how this all fits together, would be relevant as well.
Joining us now for more on the state of the U.S. economy and the road ahead for the Fed, we have Jennifer Lee, BMO Capital Markets Senior Economist. Jennifer, always a pleasure to get some of your time and insights here. In some of your notes, you've said that there's one more rate hike to come and not expecting rate cuts until 2024. Set some of the thesis around that for us and what you anticipate the Fed will do with the data that they've ingested thus far, plus some additive to come in the weeks before their next meeting.
I think first of all, good morning, and thank you for having me on again. They've already hinted quite strongly that there's probably just one more rate hike on the horizon, but of course, everything is always data dependent, and they will probably be deciding on a meeting by meeting basis. But at the same time, again, as your previous guests have been talking about, as the New York Fed president has been saying, inflation remains far too high. And why would they start cutting rates so quickly? So I think at the earliest, we could see a rate cut would be coming in probably in late 2023 at the earliest. But our base case scenario remains 2024 before we start seeing the funds rate start coming down.
So what does then growth look like if we do get a sort of holding pattern from the Fed at the same time that, I guess what I'm asking is, do you expect financial conditions to continue to tighten even if the Fed itself is not continuing to tighten? And then what economic effect will that have?
So financial conditions have already started to tighten a little bit, thanks to this, banking crisis that we saw. I guess it's been just about a month ago now. But at the same time, with 475 basis points of rate hikes already in the bag, or at least, already in the bag, that is starting to have an effect, obviously. We won't feel the full effect for probably another few more months at least, but we're probably starting to see that recession coming into play. We had a very strong start to the year, thanks to weather. Warmer weather helped, of course. So we saw like super strong numbers for January. There's a lot of expectation that February was going to pull all the way back, but that didn't happen. We saw some retracement, but not a full retracement. So that actually set the stage for a pretty solid start to the year. But so far, the March data have been a little more on the wobbly side. So I think this is sort of the beginning of when things start to slow. We've been penciling in 2 consecutive quarters of negative GDP growth for Q2 and Q3. We've actually, frankly, been pushing out that start of the recession thanks to overall resilience of the U.S. economy. But we do look for 2 consecutive quarters of negative growth in Q2 and Q3 before things start to pick up in the final quarter of the year.
Jennifer, even in the areas that are starting to show some slowing, what, in terms of the trend that the Fed is looking for, how long do you believe that trend is on a month-to-month basis that they're going to be monitoring for to say, okay, now it's time for us to pause, or now it's time to us to even start to talk about what cutting may look like in the future and what the economic impacts of that might look like?
So for any particular, data point, you can't just look at, and then, obviously you can't look at just 1 month because 1 month does not make a trend. But at the same time, it's all going to be, they're going to be focusing on the trend itself. And of course, ultimately it all comes down to inflation, which again remains far too high. And this is why, as you've been saying, everyone's waiting on pins and needles, very much so for tomorrow's inflation report. But of course, at the end of the day, it's not going to be riding on just that one inflation report. It's interesting, I think nowadays it's how, back in the old days, we will only be looking at headline inflation and then core. But now, you're breaking it down further between there's headline, core, and then you break it down between goods and services. And goods, we're finally seeing that disinflation that the Fed chair talked about a couple of meetings ago. The services inflation remains far too high. And then within services, now we're breaking down between that into that super core component, which excludes all those other different various components, which I'm getting very confused about because there are too many components out there to focus on. But it seems like they're drilling it into lower or deeper and deeper into components to make sure that they are very comfortable with the fact that inflation is getting down to that point where they will be able to comfortably, again, signal a pause and then eventually start cutting rates next year.
Jen, I'm glad I'm not the only one who is confused by all of the components of inflation. Speaking of inflation forecast, the IMF is out with its new global growth forecast this morning. For inflation specifically, it says it's going to go from 8.7% in 2022. It's going to fall to 7% in 2023. That's globally, right? That's not just in the US, but that's not like it's great news here. How sustained are we going to see, a rise in inflation? Is this going to be a years-long situation where we can just expect inflation where once we didn't really have any?
Right. Of course, every country is going to be different, but globally inflation will remain high because, we still have a lot of upward pressure, for example, on global food prices. And that could be still ongoing impact from, the war. And of course, Mother Nature has a big say in all this as well. So we've got a lot of, so food prices still remain very high. So that's probably one of the big factors supporting global inflation. But every country has its own issues right now. The US, again, is still far too high. Canada's actually been coming down quickly. So we're just over 5%. The UK, doubled their inflation rate is still twice the level here in Canada at 10.4%. So they still have their, again, they're still working on the headline itself. In the euro area, we saw a big decline in the headline CPI, but that's due to base effects. Core CPI remains at a record high. So again, every country, and then we saw CPI numbers coming out of China this morning, and that's coming down because of weaker demand. So every country, different circumstances, which is why all these different central banks are sort of approaching it with different types of gloves on.
Yeah, most definitely. So just to focus on here in the U.S. for a sec then, if we're coming down this year, when do we actually get back down to the Fed's target of 2%? And then does it just stay there?
I don't think it's going to stay there, but it's always going to be volatile and hovering around the 2% mark. But we do have it coming down to 2% by the end of 2024, just over 2%, and that's again due to aggressive Fed tightening and the appropriate response from the economy, which is slowing demand, and at some point a labor market that's a little bit more balanced than it is right now.
All right, we'll see what happens. Jennifer Lee, BMO Capital Markets senior economist. Thanks so much. Good to catch up with you.
Thanks.
And for more on the IMF's latest global projections that I alluded to, be sure to tune in to the 11 a.m. hour. That's where Yahoo Finance is going to get the chance to speak with IMF's chief economist about those numbers and those projections. And let's get to a trending ticker now. Shares of national cinemedia skyrocketing after AMC Entertainment disclosed its stake in the cinema advertising platform. It's a penny stock here. It's still going up a lot, and it's still only 23 cents. AMC revealed a roughly 9% stake in National Cinemedia, placing AMC as the second largest shareholder, trailing behind movie theater operator Cinemark. So a 73% gain. I have a feeling some of the investors there are the apes who love AMC. Coming up, a new player has entered the artificial intelligence space. We'll break down Alibaba's answer to ChatGPT and what regulators have to say about it next.
TikTok is the hottest social media network around, but it also has plenty of detractors, ranging from the US military to lawmakers. And with the potential ban on the horizon, you might be asking yourself whether you should try to kick your TikTok habit now rather than having to go cold turkey later. But doing that will require more than just deleting the app from your phone. If you really want to give up TikTok, you're going to have to delete your account as well. Thankfully, there's a relatively painless process to do so, although the company, like other social media networks, really does try to get you to stick around. To delete your account, you'll have to go to the main homepage, then your profile by tapping, well, the profile button at the bottom right of the screen. Select the options menu by tapping the hamburger button, or those three horizontal lines in the top right corner of the screen, and then selecting Settings and Privacy from the pop-up window. Next, select Account, then Deactivate or Delete Account, and finally, delete account permanently. All of your videos are going to be deleted when you delete your TikTok account, so the company gives you an option to download your old TikToks. If you don't want to do that though, press Continue. Finally, you'll reach the confirmation page. Here, TikTok will explain that they hold on to your data for the next 30 days, and then if you decide to come back, you can just reactivate your account. After that 30 days though, everything's gone. Press Continue, and your TikTok account should be gone.
Industry and government officials have expressed concern about the use of artificial intelligence tools like ChatGPT. The White House is now reportedly examining the risks associated with the use of AI. This comes as China unveils draft measures for managing generative artificial intelligence services as well. Those rules follow a slew of Chinese AI chatbot launches from Baidu, SenseTime, and most recently Alibaba. Here to break down all of these developments in the AI landscape is Yahoo Finance's Ali Garfinkel. Good morning, Ali.
Good morning, Julie. So as the AI hype cycle has really picked up, so have concerns about the technology. And those concerns, right, you said it, they've gone straight to the top. In China, for instance, the Cyberspace Administration of China, the CAC, has drafted a series of rules for how AI should be managed and regulated. And those rules include things like users must submit their real identities, for example, or companies are responsible for the data that is training their products. Another one is that the content shouldn't subvert state power, right? These rules are obviously something that, you know, a company that's trying to get its AI product off the ground probably isn't so excited about. But the stakes for complying are relatively high, right? These companies can receive fines or even facing criminal investigations if they violate these rules. And these rules aren't a pie in the sky future thing. They could take effect as soon as this year. Now, as these regulations take shape, right, of course, there's this world of companies that are involved in China, right? You have SenseTime, Baidu, and now Alibaba. And the same is true in the US, right? You have a world of companies that are also getting involved in AI, from Google to Meta. I almost said Facebook, but I didn't. And for those companies, but of course Microsoft, and for those companies, they also are facing similar concerns, right? The Commerce Department, for instance, today put out a formal request on what accountability measures for AI could entail. That, of course, could include a certification process for products before they hit the market. President Biden last week even discussed AI with a council of advisors, and when he was asked about whether or not AI was dangerous, he was non-committal. So these are early days, right? Regulation still has a very long way to go, but the first steps absolutely have been taken. And I can't help but think of this in the context of other tech I cover, for instance, VR and the metaverse. And the reality is no one is talking about regulating the metaverse, but they are talking about regulating AI. And I think in the end, that's symptomatic of how far AI has already come in the public's dreams and nightmares.
Well, yeah, artificial intelligence has been real for quite some time, too. I mean, it's embedded within products that some corporations already use, especially on the cybersecurity front. And so now generative AI as a subset within artificial intelligence getting a lot of focus. There is a question, though, of for companies that do have clients that are global at the end of the day that buy into some of their solutions, what does that mean if they, operate in China or vice versa, operate in the US, but are trying to sell a product or solution that uses generative AI into another region in the world? Is there any discussion around that right now?
There's certainly discussion, but there is absolutely no clarity, Brad. And yes, of course, AI has been around for a long time, but I think the stakes have just gotten so much higher. I think with generative AI, even though it is not the only AI out there, it has raised public awareness of what is possible, both for good and for ill. And yes, I think you're right. A lot of companies, for instance, if you're Microsoft, you're going to want everyone to be able to use the new Bing, for example. But I think those processes will get more complicated. I think we just don't know what that will look like. And I think for companies operating internationally, there could be an incredible spider web of regulations they might have to go through in the end. That said, we are still far away from that moment.
And speaking of the spider web of regulations, there are going to be some probably new in China as well. We just got some new proposals today. And Alibaba has also been introducing some new chatbot functionality.
Yeah, it has, and it's the sort of thing that we are seeing across the board for a lot of companies. I personally wasn't surprised when Alibaba got involved, especially when you saw the popularity of Baidu's efforts, for example, or you saw the popularity of ChatGPT and how Microsoft was lauded for getting involved. So yeah, Alibaba is absolutely in the mix, but it's important to remember Alibaba is in a lot of ways more like Amazon than it is like Google or Microsoft. So it'll be really interesting to see the commerce applications of how ErnieBot really plays out. And I think it's, one of the key problems in e-commerce is conversion. And one thing I've been hearing a lot about, Julie, is the idea that these very sophisticated conversational AI bots can help with customer conversion so that these e-commerce giants aren't leaving money on the table. It'll be really interesting to see what happens. I had a source tell me the other day, this is all moving so fast that no one person or company could ever keep up. I honestly think in this tech earnings cycle, we're going to still see a lot more talk about AI than we've already seen even before.
All right. Well, there's Ernie, there's Bard out there. There was Sydney. I don't know if Sydney is still the thing for Microsoft Bing. Did they change that
Sydney
yet?
was the alter ego.
It was the alter ego? Okay.
Sydney was the alter ego.
I don't know that they meant to have Sydney.
Sydney wasn't supposed to be.
Yes, there's Bloomberg GPT. Never forget Bloomberg GPT.
Oh.
Always forget Bloomberg. No, I'm just kidding.
Yahoo Finance's Allie, we're going to leave things there before they get a little testy here. Allie Garfinkel, thanks so much for joining us and breaking this down. All right, guys, coming up, Tilray is announcing a new acquisition despite reporting a $1.2 billion loss for the quarter. We're going to speak with Callan's Vivian Asian. It's next. Tilray sinking today after the cannabis company announced its acquisition of Hexo, despite reporting a $1.2 billion loss in the third quarter as it looks to consolidate the Canadian market. Vivian Azer, Cowen Managing Director and Senior Research Analyst, joins us now. Vivian, great to have you here. First, as we're thinking about what took place during the quarter and the prospects going forward from here as Tilray sees it, what really jumps out to you?
Yeah, thank you for having me on. I think the first thing that's most important to clarify is that the $1.2 billion loss is in vast majority a function of a large asset impairment. That's a non-cash charge and is just a function of the fact that valuations were much, much higher when Tilray and Aphria were combined. And so that's really more of an accounting nuance than anything else, and is not necessarily a reflection of the cash generation of the underlying business, where the company did reiterate their target to generate positive free cash flow in fiscal 2023.
I mean, that said, Vivian, the business is not going gangbusters, I think we can say, right? And what we have in this Hexo acquisition, it seems to me, as someone who's not as steeped in this as you, that we see CEO Irwin Simon sort of employing a similar strategy to what he did in the packaged food industry, where he's sort of rolling up a lot of different assets. Is this going to be as successful as it seemed to be when it came to food?
So certainly you're absolutely right, Julie. That consolidation strategy is well evident at Tilray, and it's not unique to the way that Irwin's approaching the cannabis business, because it's the exact same strategy that they're pursuing in beverages. And I think that what they're trying to accomplish here is to create a very durable CPG business. The beverage M&A is much more stable and frankly, much more profitable on an ongoing basis until we get better underlying fundamentals around the cannabis marketplace. So I think they're using consolidated beverage portfolio to help fuel some of that cannabis M&A. Certainly the jury is out on whether, consolidation ultimately drives better market share and revenue performance. What I will say is unique about this transaction is that while there has been quite a lot of M&A in cannabis, I think you would be hard pressed to find a transaction where close to half of the value can be made back with cost savings. So specifically, it's a $56 million transaction, and the company is targeting $25 to $30 million in cost savings.
And so what will determine whether or not this acquisition is successful? Because the type of consolidation that we have seen in the space is typically for either taking on more licenses to operate in certain regions, or for vertical integration for the cannabis companies that are trying to maintain more of their operational footprint. So what deems this a good or a bad acquisition? And over what period of time would you be watching that?
So I would just remind your audience that these two companies had an ongoing strategic relationship, so they're not starting from square one. For the last 9 months, they've been working together on joint manufacturing, leveraging each other's core competencies, and both companies have been stripping expenses out of the business as a function of that strategic relationship. That certainly gives you more line of sight in terms of the achievability of the targeted cost savings. In terms of the KPIs for success, probably a year or two. They're targeting a close of the transaction in June of 2023. But I think, market share takes time to turn around given the nuances of the Canadian marketplace. But each company does have their clear distinctions in terms of capabilities from a production standpoint.
Vivian, you did decrease your price target as a result of these numbers and the deal to $5. And you talk about the struggling Canadian market, and you're mentioning it here. What needs to change in the industry for things to get better? Or is it just that this is a commodity business and this is kind of what it is?
So, a lot of industry operators have been calling for a consolidation in the market as a necessary mechanism to improve the economic backdrop. Certainly, Tilray's CEO, Irwin Simon, has pointed to very high tax. I don't think they're going to get any tax relief here. So I do think a consolidation could certainly be beneficial. Ultimately, what we're facing is a lot of price deflation in the marketplace. The P&L impact at Tilray specifically of price deflation did abate, thankfully, in fiscal 3Q as a $3 million headwind versus a $12 million headwind in the prior quarter. But price deflation continues to be problematic. I don't think it's because the product is a commodity. Certainly you could argue that flower is, but there are a lot of other form factors that are value add, which we can certainly see in the United States consumers are willing to pay a premium for, things like vapes and edibles.
In the absence of significant legislation that was expected, perhaps, during the Biden administration, one of the topics that was discussed even in the campaigning leading up to the 2020 election, if we were to see a more significant shift even in the next general election, how much further out does that push legislation for cannabis, and then even furthermore for the publicly traded entities? What type of period are we talking about that they might need to wade through just for that next major wave of some type of legislation to even be discussed or put to a vote?
Well, I think as it relates to Tilray specifically, that's a ways off. They've been really clear that they wouldn't enter the United States unless there was federal legalization. In partnering with my policy counterparts at Cowen, in particular, Jarrett Seaberg, we're not looking for federal legalization anytime soon. What we had been hoping for in the 117th Congress, when Democrats had control of both the House and the Senate, was safe banking passing, which wouldn't necessarily impact Tilray, but would certainly be a step in the right direction for federal legalization. That did not materialize. We're not looking for anything to happen between now and the 2024 election either. So anything really meaningful in terms of federal change in the United States, we think is a ways off.
Yeah, if the Dems couldn't do it when they had control, not going to do it in divided Congress is for sure. Vivian Azer, thanks so much. Good to catch up with you. Cowen, Managing Director and Senior Research Analyst covering cannabis and consumer products. Coming up, Warren Buffett is doubling down on his Japanese trading house investments. Why and what are they? We'll tell you next. Shares of Japan's largest conglomerates, the so-called trading houses, are in focus today following news that Warren Buffett, the chairman and CEO of Berkshire Hathaway, of course, has upped his stakes in Japan's 5 largest trading houses. CNBC reports that Berkshire has raised its positioning in all 5 of them to 7.4% each. That's up from about 6.2 to 6.8%, according to November filings. What are these trading houses? Well, it's companies like Mitsubishi, Mitsui & Company, Sumitomo, names that we have heard of. And they're called trading houses there, or Sogo Shosha. In Japanese, I guess. And basically, you and I would call them conglomerates. They have a number of different business holdings. And this also coming, the news also coming via an interview that he gave with Nikkei, the Japanese newspaper, and saying basically he was considering doing this. And now it sounds like he's done it, at least in part, that he likes these companies.
Yeah, we're talking about trillions of Japanese yen worth of exposure that they would have some type of investment into here. Mitsubishi for itself has about 23 trillion Japanese yen of exposure. And so for Berkshire Hathaway, identifying, especially as the IMF, even within their own projections for where the largest amount of growth could take place here, and largely focusing in for 2023 on China and India, a large kind of part of that equation, too, is within the Eastern Hemisphere where some of the other growth efforts could be concerted. And in Japan specifically, Berkshire Hathaway perhaps at least seeing some opportunity there in initiating this investment that it sounds like they already had relations into many of these entities anyway.
Exactly. And Buffett, by the way, is in Japan. That's where all this is coming from. He's meeting with representatives from these trading houses, some of which you could say are somewhat like Berkshire itself, right? In that they make these investments in a lot of different things. And one of the other interesting quotes he gave to Nikkei, he said, "We would love if any of the 5 would come to us ever and say, we're thinking of doing something very big, or we're about to buy something, we would like to partner," or whatever. Ooh. So that's an interesting part of this also, that they could go in together on some kind of investment, is presumably what he's hinting at there.
All right. When Omaha meets Japan, big deals coming, everyone. Guys, coming up, we got to talk about Mickey D's, the Golden Arches, McDonald's, whatever you're calling them. Call them getting an upgrade after our next guest says he's encouraged by the fast food giant's business restructuring. We're going to discuss that next. We're taking a look at shares. They're flat right now. We've got more on the other side. McDonald's receiving an upgrade from analysts at North Coast Research, the Ohio-based research firm taking a positive stance on the burger giant's recent cost-cutting actions, saying that its recent restructuring will result in a streamlined business model that will help stores recover margins despite cost inflation. Joining us now to discuss, North Coast restaurant research analyst Jim Sanderson. Jim, thanks for joining us first and foremost here. Help us go further into some of the research here and what you're anticipating, especially as we're kind of tracking McDonald's share price reaction even on this report.
Well, we're watching pretty closely the restructuring in place at McDonald's. There have been, headcount reduction announcements that are in process, but we really think what's coming out of that is a broader strategic restructuring where you're going to have an organization in the U.S. that is more streamlined, more centralized, and that's going to fit well with the new leadership that's coming on board. You've got a former Chipotle executive that will be joining McDonald's. I think she's just joined recently. She's got a great background in store development in the United States from Chipotle, and she also has that experience in looking at digital and technology applications to build the platform and to really improve the customer's accessibility to the brand. I think that's something that she will add to McDonald's, really leveraging a lot of the technology that McDonald's has developed. And they're in a stage now where they can grow. So I like the setup with respect to how the company is restructuring, the strategy they've got in mind. So they've got a new team and new team structure developed, and now they're bringing on new leadership that is really adept at technology and technology applications. I think that's exactly what restaurants in the United States need. And with McDonald's being a leader, I think this is a great way for them to enhance and strengthen their leadership position in the restaurant industry here in the U.S., which is still their most important market, even though they are, they're globally operating.
Right. Jim, it's Julie here. When we talk about the tech companies cutting staff, we talk about how bloated they got, maybe they overestimated growth and hired too much. Is that what happened with McDonald's also?
I think you've seen the actual dollar overhead expenses creep up a little bit after 2019. I think what we're expecting out of this restructuring is hopefully they're going to go back to a more stable dollar budget, and that will result, as system sales grow, that will result in a lower percentage of revenue, let's say. So they're actually going to try to stabilize their budget for overhead and then focus on sales growth with the streamlined organization. So I don't necessarily want to say that they've gotten too fat per se, but I think that they are looking at what their business needs are currently and how they can adapt that and really get back to a position where you're starting to generate some leverage on that investment in overhead, not necessarily grow it to drive growth. And remember, McDonald's is coming off of an extensive multi-billion-dollar investment in their U.S. store system. They've remodeled a significant number of stores. They're coming to the end of that. And I think that there's going to be a shift in strategy that, again, may not require the level of investment that we've seen in the past.
With this type of restructuring, what do you believe the prioritization coming out of it is for McDonald's? I mean, we're talking about reductions in compensation packages, title changes, demotions in some cases. That's no doubt a hit to some of the internal sentiment. Have we ever seen even a correlation of a company's performance even after they roll out some of these structural changes?
Well, the cultural impact is something we want to be aware of and watch. So I think that's always a challenge in these transitions. When you do look historically, the last time there was a round of headcount reductions at McDonald's, again, you did see that nice stabilization of the dollar budget, and that allowed the sales to grow at a quicker pace than overhead expenditures, and that improved or strengthened the store margin rates, the corporate margin. So I think that was very constructive from a shareholder perspective. Again, what I like about the process here is the strategy behind it. So I think you do have cases where McDonald's has successfully restructured their employee base and come out of it stronger, and we're hoping that will be exactly the same outcome this round too.
Jim, we always like to ask about buzzy products as well. And one of your colleagues at another bank was talking about the potential for the Chicken Big Mac, and that there was some interest in that. What can you tell us about that and how big of a catalyst maybe that will be for McDonald's?
Well, the chicken sandwich and the chicken category is an incredible opportunity for any quick serve restaurant. It's a key driver. It's one of the top reasons the consumer goes to a quick serve restaurant, even if it's a burger restaurant. we're in a context now where we've got significant beef inflation that we know is coming down the road. So I think shifting over to products that focus on chicken is smart. The cost of chicken, I think, will be far more reasonable than beef. We don't really anticipate that the inflationary pressures we expect in the beef category will be similar. And so in that context, it's smart to try to introduce products that really meet or hopefully build consumer demand and interest, but at the same time can help operators, franchisees improve their profitability. So I like the idea. Excited to taste it. Let's see what they come up with and how it works, how it functions.
Jim, is McDonald's still the Nugget King? And if not, who is taking share or taking their lunch?
No comment. I think that McDonald's innovated in the chicken category, and whether they're the king in nuggets or whether they're, bringing the consumer in. They had, the launch of the chicken sandwich, the crispy chicken sandwich was pretty successful. So they've got lots of options. And I think that's the benefit for McDonald's right now, is keeping those options alive, so to speak, driving interest in the brand. I think we saw that most, in my opinion, with the adult Happy Meal. That wasn't necessarily a menu innovation, but it was the repackaging of similar items. But it was amazing how effective that was in keeping the consumer interested in McDonald's as an option when they dine out. And I think that's what we're hoping for any of these new menu innovations that are coming down the pipeline, in addition to the technology innovations that hopefully will make it easier for the consumer to access the brand in the U.S. as well.
Jim, thanks so much for your time this morning. Good to talk nuggets and everything else. Jim Sanderson,
there you go.
North Coast Restaurant Research Analyst. Thank you.
You bet. Take care.
And a programming note, stay tuned for Yahoo Finance's coverage of earnings season, kicking off this Friday with big banks, JP Morgan and Wells Fargo. You don't want to miss that. It's not nuggets, but we'll have lots of nuggets. We'll be right back. We're digging into some new data from a new survey from Pew Research that breaks down why workers are not taking all of their vacation time. There are a lot of different reasons for them to do so. Tops is they don't feel they need to take more time off. They worry they might fall behind at work is number 2. They feel badly about coworkers taking on additional work. That's number 3 with 43%. They think taking more time off might hurt their chances for advancement. That falls to just 19%. They think they might risk losing their job. That's a scary one, 16%. And then finally, 12% say their manager discourages taking time off.
I mean, this important survey here from Pew, I think in tandem with another survey that they had done at the end of March, or at least released the data from the end of March, a lot of workers still place high priority on paid time off. It's just a matter of who's actually getting that, which companies are continuing to offer that, especially as they are even restructuring the way that they look across their workforce and what benefits are being offered. 6 in 10 workers, 62% in a survey that was released at the end of March, said that it's extremely important for them personally to have a job that offers paid time off for vacations. This just gives us a little bit more of the details around why they aren't using that as well. And I honestly can't think of too many years where I've used all of my vacation time. I'm sorry, but this
Why?
year, I'm going to try this year.
This is my message, unequivocally, to everyone who has paid time off. Obviously, if it's unpaid time off, that's a whole different thing.
Hear you.
Take all your time. What are you doing?
Yeah.
Take every single day that is allowed to you as an employee. You don't need to take more time off. You need the time off. Just take it. Just do it.
I'm going to do it.
Do we work to live or do we live to work?
Work to live. See, the New Yorker.
I love my job. Don't get me wrong.
Yeah, I know.
I love my vacation.
Yes.
Even if my vacation is just sitting on my couch. It's good for you. It's good for your mental health. It's good for your physical health. It's just
balance.
You can tell, I'm a preacher for vacation.
Well, but that's the thing. Corporations need to be doing more advocacy around the types of experiences that their employees and balance and well-being that also gets promoted with just taking that time to yourself.
And one more thing for the person on the team who might think, I don't want to make more work for my colleagues, they'll be okay. And then when they go away, you'll do the extra work. Everybody supports each other.
That's a fact, yeah.
Take the time, my friends. All right, that's my little soapbox.
Drops mic.
That's my little soapbox for the day. We've got some great interviews lined up all day at Yahoo Finance. The commercial real estate market, it's facing a growing risk of increasing defaults after those recent bank failures complicated things for the sector. Rochelle Akufo is going to discuss what could happen to commercial real estate and who's on the hook with the CEO of Marcus & Millichap.
And later on in the hour, IMF chief economist is going to join Yahoo Finance's Jennifer Schonberger to discuss global economic outlook as well as the spring meetings. Those are kicking off in D.C.
Also, tax day is just around the corner. If you're filing your taxes last minute, you're not the only one. We've got you covered all week long with tips and tricks on how to navigate these final days of the tax season. Today, we'll be speaking to a TurboTax expert on how to file based on your investments. You don't want to miss that. We got all of that and more coming up your way on Yahoo Finance. Rochelle Akufo has you for the next hour of trading. Have a great day, everybody.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. The New York Fed's John Williams tells Yahoo Finance monetary policy is in restrictive territory, but he's watching the data closely. So are investors, and tomorrow's key inflation reading could be the next big driver for stocks. Now, Williams doesn't see a direct link between the Fed and the recent bank collapses, but they do have the attention of the IMF. It lowers its global growth outlook amid shocks to the financial system. We speak with its chief economist this hour. And the doom and gloom doesn't stop there. Small businesses are feeling cynical. A major survey isn't happy reading, with concerns over inflation and filling job openings just some of the major issues. We'll take a deep dive into the details. But first, let's check in on the major indices. We're seeing a mixed picture here at the moment. Only the Dow in positive territory. They're up about 0.25% there. We're seeing that Apple and Microsoft are weighing on the Dow. Some of these bigger tech names, obviously also weighing on the Nasdaq as well. Amazon weighing the most on the Nasdaq. A little bit of green there from Tesla, but near the session lows there for the Nasdaq. As we see, that's off about 0.6%. S&P just barely in negative territory, though down almost about 2 points there. We're seeing tech and consumer discretionary under pressure the most. Let's also check in on the Treasury market as well. Investors do seem to be more open to some of this higher risk, higher reward investments, as we can see from the bond action here, because the 5-year up 0.7% on the day, the 10-year up 0.6%, the longer-term 30-year yield up just slightly there, about 0.25%. Well, the Fed signaling rates are set to remain higher for longer. In an exclusive interview, Yahoo Finance spoke with New York Fed President John Williams earlier today and discussed what it would take to bring interest rates down. Take a listen.
I think the real issue is if inflation comes down, we're going to need eventually, not soon, if inflation comes down, we'll need to lower the interest rates, because otherwise real or inflation adjusted interest rates will go up. So if you look at the projections in the economic projections that we put out in March, we all, or at least the median dot, has the funds rate going down in next year and the year after. And I think that's really primarily driven by the fact that inflation is coming down and we'll be moving monetary policy to a more normal stance. So I think that's an important driver of inflation, of interest rates eventually coming down. Obviously, other factors, how the economy is doing and how this all fits together, would be relevant as well.
I want to ask you about risks to the economy. A lot of folks are saying commercial real estate could be the next shoe to drop. Of course, we heard that back in 2009 after the financial crisis didn't come to fruition. Nevertheless, what are you seeing? You're here in New York on commercial real estate.
Well, clearly commercial real estate, especially office space, there's a lot of open questions about what's going to happen there. With a hybrid model and fully remote work, companies are using office space differently. The demand for office space will be changing. I think that does affect the market price of a lot of those buildings, both here in New York, but in other big cities. So that's clearly something that will have to be resolved over time. It's not something that happens on one day. And there, like you mentioned, in the past, we've seen typically the borrowers and the lenders work things out in a way that's not disruptive. But that said, it's definitely something very much on my radar, both in terms of the New York City economy, but also broader conditions.
On credit conditions, I know you say you're not seeing too much of a tightening right there. Of course, we'll see what happens as time plays out. But given these bank failures and the question mark of the magnitude of that, how much does that raise the odds for a recession?
Well, I think that, again, we're in a situation where even before this, growth was going to be relatively modest. And so, it's hard to predict recessions. If you ask economists, they like to predict them, but they're not, the track record's not very good on that. I do think it's a factor that could influence confidence, consumer and business confidence, and it could affect the availability of credit. So we'll have to watch that. It clearly could be a negative shock to the economy and cause the economy to slow further. But right now, we're not seeing those effects, and actually the banking system is really stabilized, and so it's pretty much focused on the two banks that failed. So I guess right now I'm not thinking that it would be such a big negative on the outlook, but we're gonna have to watch the data carefully.
Mm-hmm. Yeah. To your point, we are going to see slower growth. You project this year, maybe not a recession, but slower growth. If inflation remains persistent and interest rates need to remain high as a result of that, what is the prospect for a stagflation scenario?
Well, I really don't see that. One of the things we've actually seen in the labor market, and we started with the labor market, so I'll come back to that, is as labor demand has come down, we've seen the job openings data come down, we've seen wage growth come down, but we haven't seen unemployment go up, at least so far. So I think if we can get this nice balance of supply and demand in the economy, where demand comes back in a way consistent with supply, we don't need to have such a negative effect on the economy, and at the same time reduce the inflationary pressures. So I think we've got some things that we've already talked about that are helping us bring inflation down. Some of the pandemic effects and supply chain issues are now fading, and it's really a matter of just getting supply and demand back into balance. Demand is still far exceeding supply, and that's what monetary policy can do.
That was New York Fed President John Williams alongside Yahoo Finance's Jennifer Schonberger there. Well, as we take a look, tech stocks hoping for highs to continue on expectations that a Fed rate pause means easy money access. But with the New York Fed's John Williams indicating rates will remain high alongside inflation, a tech trader's out of step with the Fed's direction and reality. Joining us now, Erica Clower, Jennison Associates Technology Equity Portfolio Manager. Thank you for joining me this morning, Erica. So as we're seeing here, though, tech does still seem to be fighting the Fed in terms of when it's expecting a rate pause. Who's more in tune with reality? Obviously, the Fed looking at some backward data, but investors, especially in tech, really going ahead here.
Well, you're right, Rochelle. Thank you so much for having me today. I think that the interesting thing that's going on right now is we have a push-pull scenario between the incredible new innovations that are going on in technology that apply to all different industries, whether that be automation and robotics to artificial intelligence. These are new, very usable technologies that have significant implications on things like productivity of workers, against a backdrop of tighter lending, more difficult credit conditions. And so really here at Jennison, what we're trying to do is piecemeal through and figure out which companies can benefit from those growth vectors while withstanding the headwinds associated with the economy.
And so, on top of that, we have a slew of economic data out this week, and we've seen the market reaction with every bit of data that's giving them a hint of what the Fed might do. We have core CPI and PPI, retail sales, consumer sentiment. So as people are looking for short versus long-term headwinds at the moment, what are you tracking?
Well, I think that the main issue that we really look for are the tools of innovation that are becoming more and more prevalent in this economy. I'll give an example. For artificial intelligence, a lot of people have talked about ChatGPT, but ChatGPT is really something larger, which is known as a generative tool where you can actually create content out of machine data. So, for example, drug developers can look at reams and reams of data and come up with better tools for predicting what drugs will be effective. Or alternatively, one can try to create a marketing campaign with input tools using generative AI, and or lawyers will be able to create legal documents using generative AI. So from Jennison's perspectives, we're really a bottoms-up company and are looking for these trends in the companies that can capitalize on them. So that, I think, is the best strategy now, is to try to figure out which companies are really at the vortex of these extremely innovative trends that we're beginning to see materialize in early 2023.
And as we're seeing governments really race to get to the forefront of this, there's also a little bit of a moment of pause here. We see the Wall Street Journal reporting that President Biden and his administration weighing possible rules surrounding AI tools like ChatGPT. What does that do for the investment landscape?
So you bring up such an interesting point, which is that we've never seen such significant government intervention, both positive and negative, for implications for technology. On one hand, if you think about and you added up all of the initiatives and support that governments have announced around the world to build more semiconductor manufacturing, this is very positive as it helps companies become more innovative, and it brings next generation technologies to the market sooner and in a more inexpensive manner. At the same time, you have governments at battle with one another in terms of who gets access to those technologies. Many of the US generated technologies, as well as European based technologies, are now being restricted and banned from shipment into China, which of course is a negative. and forces Chinese governments into trying to homegrown more of their own technologies. And as you say, there are oversight tools that are going to be needed for the efficacy and accuracy of many of those ChatGPT-like functions.
So then you note a couple of these multi-billion-dollar areas of opportunity that you note. But when you think of the supply chain that does involve other countries like China, as the US gets more up to speed on this, who are going to be the big winners here company-wise? I know you're looking at Broadcom and NVIDIA.
So certainly at Jennison, we are looking for the companies that have the highest barriers to entry, the best possible management teams, and the strongest balance sheets that are leveraged to those trends. At the very top of that list is NVIDIA, which has done very, very well so far in 23, but we still see a lot more room to go. We also like Broadcom, which makes custom products for the likes of Google and other hyperscalers. And we also like Advanced Micro Devices, which is a viable and important contender to NVIDIA's dominance within the data center, but also has a very important and growing position within the personal computer business, gaining quite a bit of share from Intel Corporation.
So certainly opportunities to be had here, even though the future not necessarily set in stone a lot, especially with policymakers on board as well. Erica Clower there, Jennison Associates Technology Equity Portfolio Manager. Thank you for your time this morning.
Thank you.
All right, coming up, you're welcome. All right, coming up, the elephant in the room. The New York Fed's John Williams says SVB's collapse wasn't the central bank's fault, but systemic risk still lingers, and it's a real threat for over $1 trillion worth of commercial real estate debt. We take a closer look. Stick around.
TikTok is the hottest social media network around, but it also has plenty of detractors, ranging from the US military to lawmakers. And with the potential ban on the horizon, you might be asking yourself whether you should try to kick your TikTok habit now rather than having to go cold turkey later. But doing that will require more than just deleting the app from your phone. If you really want to give up TikTok, you're going to have to delete your account as well. Thankfully, there's a relatively painless process to do so, although the company, like other social media networks, really does try to get you to stick around. To delete your account, you'll have to go to the main homepage, then your profile by tapping, well, the profile button at the bottom right of the screen. Select the options menu by tapping the hamburger button, or those three horizontal lines in the top right corner of the screen, and then selecting Settings and Privacy from the pop-up window. Next, select Account, then deactivate or delete account, and finally, delete account permanently. All of your videos are going to be deleted when you delete your TikTok account, so the company gives you an option to download your old TikToks. If you don't want to do that though, press Continue. Finally, you'll reach the confirmation page. Here, TikTok will explain that they hold on to your data for the next 30 days, and then if you decide to come back, you can just reactivate your account. After that 30 days though, everything's gone. Press Continue, and your TikTok account should be gone.
Concerns surrounding commercial real estate came into the limelight following the collapse of Silicon Valley Bank and stresses in regional banking. Yahoo Finance had a chance to speak with New York Fed President John Williams exclusively earlier today on what he's been seeing and hearing. Take a listen.
Clearly, commercial real estate, especially office space, there's a lot of open questions about what's going to happen there. You know, with a hybrid model and fully remote work, companies are using office space differently. The demand for office space will be changing. I think that does affect the market price of a lot of those buildings, both here in New York, but in other big cities. So that's clearly something that will have to be resolved over time. It's definitely something very much on my radar, both in terms of the New York City economy, but also broader conditions.
Well, for a deeper dive on all things commercial real estate, let's bring in Hessam Naji, Marcus and Millichap CEO. Thank you for joining me this morning. So as we heard there from New York Fed Chair Williams there, talking about some of perhaps the risks in commercial real estate. But as we look specifically at some of the sectors within commercial real estate, which ones are raising the biggest red flags at the moment?
Good morning. Thanks for having me on the program. Well, office space clearly is the one that is being watched the most and in a valid way has the most concern around it. In fact, the maturities that are coming due this year are dominated by office properties that were financed 5 to 7 years ago. And the hybrid work environment and the reduced footprint in office buildings is a major concern. I do believe we're seeing the worst of it. I think in the next 2 to 5 years, you're going to see much more return to the office. It won't be pre-pandemic levels. I think there is a structural and permanent reduction of office space needs. However, we haven't been overbuilding office space, and therefore on the supply side, we have not overdone it, if you will, as we've seen in past cycles. Nonetheless, in the immediate term, office space certainly will be coming to the market at a time when interest rates are much higher, values are under pressure, and of all the different property types over the past 5 years, office has seen the least amount of rent growth. Therefore, the cushion for office is not quite there as it is for multifamily, for industrial, even for shopping centers, self-storage, and other property types that have seen rent growth. They're in a much better position than office properties.
And we did hear commercial real estate come up from the Fed earlier, from Fed Chair Powell, as we saw interest rates start to rise. But then when you couple that with what we saw with the bank failures, a lot of people wondering about what the sort of fallout that could mean for CRE. But you're saying that this could be perhaps just pose a limited risk to CRE. Walk us through your base case there.
Well, I think the concerns are a little bit overblown in that the headlines are sensational, but if you think about a loan that is coming due in 2023 or 2024 that was issued 5 or 7 years ago, has had time to see operational improvements, has had time to gain values on average, and most importantly, has seen rent growth over the past 5 years. Multifamily rents over the past 5 years are up 37%. Industrial rents over the past 5 years are up almost 50%. So it's not an apples to apples comparison of looking at those loans in today's snapshot of the market environment, recession concerns, higher interest rates, which are significantly pressuring valuations, versus the health of a particular asset and the performance of those loans throughout the last 5 to 7 years. Is there going to be some maturing debt issues? Absolutely. I do believe the number of properties that were financed in the last 3 years on short-term financing, floating rate financing, that are now having issues are going to have a hard time getting refinancing, and therefore they will depend on rescue capital. But there is a lot of capital out in the marketplace, and as values get adjusted according to the current environment, we're going to see a lot of workouts. And to the point that was made earlier by the New York Fed, lenders are much more motivated to work out situations with the current owners as loans mature than to take the assets back or discount them significantly and get them off of their books. So I don't think there would be a major ripple effect. Certainly in the near term, we're going to see cases of a challenging refi environment.
And as we look at the housing market, I mean, there's been some talk of a bursting CRE bubble. Perhaps it would be a sort of slow sort of bursting of a bubble. But what do you think about those comparisons? Because they talk about sectors like skyscrapers and shopping malls being at the cusp of that.
Well, there's certain asset classes that are more exposed. We talked about office. Shopping centers have had some issues in the past. Certainly in the last 10 years, we've seen a revolution really take hold of brick and mortar retail. But retail is on the recovery end of that cycle now, even with e-commerce being a kind of a structural, permanent, factor of life, just like a hybrid workplace is becoming that for office space. We're seeing the renovation and repositioning of shopping centers in a way that's never occurred before. And on the retail side, there's been, for sure, very little new construction. It's been all recycling and reuse of obsolete retail that is now either new retail or some other use entirely. So I think there is a surgical kind of set of areas in the marketplace that are going to have issues, but at a macro level, I don't think we're facing a systemic risk because of the fact that we haven't had overbuilding. Job growth has been very, very strong, which drives the demand for various types of commercial real estate, and different property types are performing, in a very varied fashion, even today.
And so then, as you look at how investors plan on re-engaging in this market, talk about how some of this commercial real estate debt is going to be refinanced. Who's really going to be on the hook for that?
Well, you have to remember that the disconnect between the 2008-2009 scenario and the current market environment is the lack of speculation that drove the 2008-2009 crisis. We saw loan to values exceed 80-90% for the 2 or 3 years prior to the 08-09 crash. We did not see anything like that leading into the current environment. We saw a significant amount of speculative construction leading to the 08-09 crisis. We did not see any comparable level of speculative construction leading to where we are today. So those are very different kind of periods of time and had different drivers. As far as who's on the hook, obviously the investors, the equity behind the properties that have made promises to the lenders, and some of them are recourse, some of them are non-recourse types of loans. But nonetheless, either way, it is in the best interest of the system for these maturing loans and those that are facing significant value reductions, like some of the office buildings that we talked about, get worked out. I do think there will be loan sales. There will be a lot more volume of loan sales. One of the new divisions that our company introduced last year is an auction division that is seeing a lot more demand for that outlet as a way to expedite the marketing of certain assets. So I think the market is going through a recalibration period. The higher interest rates are certainly putting pressure on values. And the Fed really did take out a sledgehammer to the economy and shock the system, unfortunately. Fastest and most aggressive tightening cycle in 40 years is going to have repercussions. We do believe that the banking concerns are going to tighten credit more and slow down the economy in the back half of this year. But we're not expecting a major recession, as most economists are not. And then therefore, we should be able to work through this period. Once the valuation resets, I think the capital is there for investing in commercial real estate.
We'll certainly be keeping an eye on that. I do appreciate you joining us with your insights. Hessam Naji there, Marcus and Millichap, CEO. Thank you for your time.
Great to be with you.
All right, coming up, recession risk. Downbeat global growth projections suggest trouble ahead. From the World Bank to the OECD and now the IMF, it isn't exactly a rosy picture being painted. We take a closer look at what the big institutions are saying later on in the show. Do stick around. The National Federation of Independent Businesses is out with its Business Trends Report for March. The survey results detailing how small business owners are feeling about the economy and recession forecasts, recent bank collapses, and a rising debt ceiling. Here to break down how these macro headwinds are impacting small businesses is Yahoo Finance's Shauna Smith. Hey, Shauna.
Hey there, Rochelle. All right, so let's take a look at how Main Street is feeling. And from this index, from this report, they aren't feeling any better about the economy or overall business conditions. It's actually starting to get a little little bit worse. NFIB releasing its small business optimism index today, and it showed that confidence actually declined in March. It's clear now that owners are very worried about their future. Most of that recent drop was driven in part by turmoil in the banking sector. The collapse of Silicon Valley Bank and also Signature Bank might be leading to tighter lending conditions. As a result, here within this survey, more of the small business owners are having trouble getting access to loans. Taking a step back here, the overall index fell to 90.1 in March, erasing the slight gains that we saw at the start of the year. Now, inflation remains one of those big issues here for small businesses. We've been talking about that now for quite some time, as well as quality of labor shortages here. So breaking that down, 43% of owners right now saying that they are having a tough time finding the workers that they need. Also, plans to hire, that actually fell to the lowest level that we've seen in just about 3 years. When it comes to inflation, prices, they continue to go up, at least for some business owners. 37% of owners raising their average selling prices in March. Retail and construction owners among the most likely to have done so. Another challenge that persists, supply chain issues. Now, disruptions are still having a significant impact on businesses, something that isn't necessarily in the headlines day in and day out. 19% of owners reported those issues, and looking at it by industry, shortages were most common in transportation, in retail, and also within the manufacturing sector. So it's clear here from these numbers, Rochelle, that things are not improving on Main Street. This is the 15th month in a row that the index has been below its 49-year average. So some things to think about here when we get the pulse of Main Street and exactly how some of these big headlines, like the collapse of Silicon Valley Bank and Signature Bank, how that's affecting small business owners today.
That's great stuff. They're connecting those dots between what's happening on Wall Street and Main Street there. Great stuff. Shauna Smith there for us. Well, the Biden administration is reportedly trying to get a head start on the U.S. response to the fast-moving AI industry. That's according to the Wall Street Journal. The government could reportedly take a range of actions that will shape the industry. Yahoo Finance's Ali Garfinkel has all the details for us. Hey, Ali.
Good morning, Rochelle. The Commerce Department today has asked for public comment on what accountability measures for AI can and should look like. The agency managing this process is called the NTIA, the National Telecommunications and Information Administration. And I think it's important to say it up front, this is very early. These are nascent efforts. Now, why do I say these are nascent efforts? Nothing is written in stone yet. Far, far from it. The reality is this move is still very short of a lot of the comprehensive AI legislation that I think a lot of critics have advocated for. That said, I loop this in with a lot of other efforts from the Biden administration that we've seen. For instance, the White House's AI Bill of Rights it released last year. And I think it's important to say that nobody knows what this regulation can and should look like. Right. But there are a lot of ideas kicking around. One of the ones I found really interesting was the idea that there could be bounties for people who figure out where algorithmic bias is in AI. Another one is one that you might expect some kind of certification process for AI before it hits the market. There are big names in the crosshairs here. Of course, you have Alibaba on the screen right here, and China is actually enacting similar efforts that were released today. But Alibaba is not the only one, right? In China, you have Baidu and SenseTime. And here in the United States, you have some of the biggest names out there, right? You have Google and Microsoft, and of course, Meta. Now, what's going to be really interesting here is that much of the industry does actually support some kind of AI regulation, some kind of governmental efforts here. However, nobody really agrees on what responsible AI could look like. So again, this is really, really early days on AI regulation, but it's interesting to see these early steps because, you know, we're not seeing them for the metaverse, right? You can't help but think of these things in the context of what you cover. And we are not talking about regulating the metaverse, but we are talking about regulating AI. And I think it shows how far the technology has advanced in the public consciousness.
Really that mix of excitement and caution, trying to be on the cutting edge there. Ali Garfinkel, thank you so much. Well, the COVID-19 pandemic was a catalyst for change and investment across the medical sector. Investors now turning their attention to new breakthroughs and advances in technology and innovation. Michael Milken's new book, Faster Cures, Accelerating the Future of Health, out now, chronicles the progress made in medical research and public health over the years. The Milken Institute chairman joins me now, along with Yahoo Finance's own Anjali Khemlani. Thank you so much for joining us this morning. I do want to talk about your Wall Street Journal op-ed here. You say that another medical revolution is on the way. For investors who are yet to see the value of that at this point, what sort of companies or advancements are you focused on?
Well, I think the major change that's occurred here in the last couple decades has been one of the improvements in access to technology. So the idea that everything was in your blood was an idea put forth almost 40 years ago, but no one could figure out what was in your blood. And many people stored blood with the idea later, could you go back in time and discovered what the challenge might have been. But as you know, the very first sequencing of the human genome took 13 years and cost over $3 billion. Today, less than an hour, and $100 to $200, and the price is dropping. So that allows us not to have to guess. That allows us to sequence an individual's human genome, sequence their disease, sequence their microbiome, and be much more precise on how we deal with disease. And so it's the technology of computers that are 1 million times faster, data storage costs dropping to 1 billionth, that has afforded us and brought us here to the age of a new medical revolution.
Michael Anjali here. I want to talk about that. You've talked about the progress that has been made in science and innovation, but what about the investment part of it? When we're talking about, biotechs and early stage especially, they're very high risk investments. How would you characterize the way that the country is handling it and the investment community is handling the responsibility of bringing these forward?
Well, there's always a challenge. And if you go back to the period of time 20 years ago or so, at one point in time, there were 180 bioscience type companies, biotech, that were public, and combined they were worth about 150 billion. Merck was worth more than all of the 180. But those 180 were spending far more on medical research and new technologies than Merck. And a couple of years later, just 2 of those companies were worth more than Merck. And so today we have large, what were biotech companies, Amgen, Genentech, part of Roche. But as you know, and many of your viewers and listeners know, November 21 was kind of the high for bioscience companies. Hundreds of these companies went public. It was maybe too early for many of them. And then a year later, we saw the prices crashing for many of these small companies, 60, 70, 80, 90%. So today we have a situation somewhat similar to where we were a little more than 20 years ago. Many of these companies have liquidity, but they sell at a discount to the cash. But what we do know is that the future in many ways is in the field of bioscience. Now, when I was at Berkeley in the 60s, there was this movie called The Graduate. And Dustin Hoffman played this young 21-year-old not knowing what to do. And he was at this event, and the father of one of the people hosting the event took him over and told him there was only one word he needed to know in his career, and that was plastics. Well, that was 1967. Today, bioscience is really the future. It's not just our health. It's energy, it's the environment, it's food. Unfortunately, it's bioterrorism defense. And so what we know today and what technology is allowing us to unleash is the power of merging technology with what we know about bioscience. And one of the reasons I wrote this book was my concern that we had come so far, so fast. In less than 1 year, we had vaccines for our COVID-19 challenge. But we have a tendency to gear up and then gear down. But this is a great opportunity for the entire world. Mm-hmm. And for my generation to eliminate many diseases that my children, grandchildren will have to deal with, There are enough problems for them to deal with. And so I feel it's our responsibility to put many things behind us, such as cancer.
Yeah, absolutely. And you're talking about that, especially with reference to COVID. I know that the U.S. government just announced Next Gen with $5 billion to replace that Operation Warp Speed plan. But in your book, you also note that, a country like the U.S. and nations in general like the U.S. that have invested in public health and medical research and innovation are the reasons why they progress. And I wonder, with this new investment, is that enough or is there more that needs to be done for us to be prepared for the next pandemic?
Well, it's not just the next pandemic, it's many other diseases. And so I think many people in the world of finance do not realize that the driver in the last 200 years of economic expansion has been the number one, public health and medical research. And it's really hard for young people to realize that life expectancy on our planet at the start of the 20th century was only 31 years of age. And so we've had this dramatic transformation. Maybe the greatest achievement of humankind has been increasing median life expectancy from 31 years to 70 some odd years. And with this has driven the world's economy. And so that is why this investment is so important. Many years ago, and I wrote about it, as we were thinking about how to increase and getting the federal government to increase its funding of medical research, we worked and put something on called the March, and it occurred in 1998, and thousands of people worked on it. 500,000 people participated. And President Clinton signed into law within a couple of months the doubling of the NIH budget. And there's been an incremental investment of almost $500 billion, $500 billion, in medical research since that date. And that's one of the reasons why, when we look back, it was only 9 weeks, 63 days between the sequencing of the DNA of COVID-19 virus and the first time it went into a human being. And so extending life, extending the quality of life at the same time has been a significant driver. It's hard for people to maximize their potential, to fulfill their destiny and what they want to do and build meaningful lives if they're constantly faced with serious medical diseases. And it isn't just the individual themselves. As you and everyone knows, it's the entire family. It might be their coworkers that are affected by a life-threatening disease that an individual has. So yes, those countries that are the leaders in bioscience will be the leaders in the world in this century.
Michael, I know one of the things you're really passionate about is equity, access to capital, and that includes health equity. But putting it all together, when we look at what has happened over the years, and especially the spotlight that the pandemic put on these topics, have we gotten to a point where we've made any progress at all with both access to capital and health equity for minorities?
Well, we've made enormous progress to access to capital for millions of companies today. So I would say, but it's not complete. Not every individual has the knowledge or the relationships. And so we do have financial deserts in the United States. And we discovered that during the pandemic, when we have millions of people that don't have a bank account. And when you wanted to support them, how do you get the money to them? We knew we had food deserts, that many parts of the country did not have a place that you could get fruits or vegetables in the neighborhood. And lastly, we learned that we had medical deserts, that we did not have ability to care. And when you realize what people have done the analysis on, and then in a 20-minute subway ride in New York, from Manhattan up to the Bronx, you shorten life expectancy by a dramatic amount, or in other parts of the country. And so health equity is exceedingly important, but there's another very important factor here, and that is the face of the United States and the world is changing. There are states in the United States now where only 15% of the children are of European ancestry. In the state of California, the majority of people under 25 are of Latin American ancestry, and the next largest, fastest growing group is Asian ancestry. And so if we have primarily Caucasians or people of European ancestry in our clinical trials, we're not going to be able to service the dramatic change in demographics that's not occurring just in the US, but around the world. And so this area of health equity, we have to find a way to get a much more diverse and representative part of our country involved in clinical trials and healthcare programs. And I think this will benefit all of us. So I think there's a major push, and data and technology have a large role to play in that effort.
Indeed, and as you mentioned there, prediction and prevention all tying in to really help with health equity there. A big thank you there for taking your time this morning. Michael Milken, Chairman of the Milken Institute, and Yahoo Finance's Anjali Kemlani. Thank you for joining me this morning.
Thank you. Thank you for what you do.
You're very welcome. All right, we're officially 1 week away from tax day, and we've got you covered with the Yahoo Finance Ultimate Tax Guide. Today, we're tackling the wild world of taxes on investments, how your market gains and losses from the year come into play when filing. Joining me now is Lisa Green-Lewis, TurboTax tax expert. Thank you for joining me, Lisa. So a lot of people probably biting their nails at the moment. They see that tax deadline approaching there. For people who've seen major gains and losses over the past year, what are the top 3 tips you have for them?
The top 3 things that they can do. First of all, you want to offset your losses against your gains. And then if you have a net loss, you can offset that loss against your ordinary income, like wages, up to $3,000. And then you also want to remember, if you have any carry forward losses, you want to capture those because those can reduce your taxes as well.
So for people who are wondering, should I be holding on to my stock even if it's going down in value? Should I be holding the line? Is this a good mindset to have in this sort of period?
You can hold on to your investments, but if you see it's continuing to lose, you may want to, sell your crypto or stock, and then you'll be able to offset those losses against your gains, and that will help your tax situation.
I know a lot of people sort of Googling what happens if they've bought and sold crypto over the past year. They've watched the roller coaster for Bitcoin as it, swung its way back up to 30,000 there. What should people be aware of in the changing environment when it comes to crypto laws?
Yeah, so crypto is just like a stock investment if you are holding on to it as an investment. So we talked about, offsetting your losses. You will be able to do that. Also, I think about it, the way you use crypto is how it's taxed. So for instance, if you're holding on to it as an investment, when you sell it, you're going to see a capital gain or loss, but you can also get paid in crypto. So when you're paid in crypto, that's going to show up on your 1099 form if you're paid as a contractor, or your W-2. So that will also be captured on those forms and reported when you go to do your taxes.
And what if you're an investor who's also a creator? Obviously, what we consider, traditional work has changed a lot in this environment. How do they navigate this space?
Yes, so if you're a creator and you created an NFT, for example, and you sell that NFT, you're going to get income from selling that NFT, and that would be reported on a 1099 as well, possibly a 1099K. And then if you invest in your NFT and you hold on to it, that's one thing to remember. People may get confused on when they report a transaction. So you don't have a taxable event until you sell that. So if you were to sell that NFT, depending on how long you hold on to it, you can have a long-term capital gain or loss or a short-term.
And for people who are looking at how to reduce their adjusted gross income, at least the appearance of it when they're trying to navigate this, see where they should make their deductions, what are some of the most important things they should be aware of?
Yeah, so you can reduce your adjusted gross income by taking a deduction for any IRA contributions that you made. If you're a teacher, there's a teacher's expense deduction that you can take. If you're self-employed, remember that you can deduct half of your self-employment taxes as well as your self-employed insurance premiums.
Certainly a lot to consider there. We do appreciate you breaking that down for us. Lisa Green-Lewis, TurboTax tax expert, thank you for joining us and taking some of the headache out of this tax season for us.
Thank you for having me.
You're very welcome. Now, when filing taxes, many remote and hybrid workers may be wondering what kind of tax breaks, if any, their business expenses qualify for. Yahoo Finance's personal finance editor, Jana Heron, joins me now. So, Jana, what tax breaks can these workers expect?
Well, here's the bad news. Those kinds of business expense write-offs are only available now to self-employed workers. So workers who are considered an employee of a company, who get W-2 forms, largely can't deduct those expenses, even if they were working remotely or in a hybrid arrangement. And that wasn't always the case. Before the tax reform in 2017 under the Trump administration, employees could take unreimbursed business expense deduction, but not now. But there are a few caveats. One, as with everything, there are a few exceptions, but these are very narrow. So if you are an employee, but you're also a military reservist, a qualified performing artist, a fee-based state or local government official, or an employee with impairment-related work expense, you can claim the employee business expense deduction, which is only available if you itemize. The second caveat is if you have a side gig, you may be able to write off some of those expenses that are related to the side gig as long as it's just for that particular hustle. If you have an expense that is shared between your W-2 employment and your side gig, it doesn't work.
So then for people who are wondering, because there can be some gray area here, who can deduct expenses related to business done at home and what can they deduct?
Yeah, so self-employed workers definitely can take lots of different business deductions. And some of the most common ones are the self-employment tax deductions. So you can write off 50% of the Social Security and Medicare taxes you pay. There's a self-employed health insurance deduction, which Lisa actually just spoke about. There's a self-employment retirement deduction. So if you have an SEP, a simple IRA, or a simple 401k, that would work. Home office expenses, so including your cell phone, your internet, your utilities. If you use your car and it's germane to your business, not you're going to get a Starbucks coffee because you need a little burst, you can also deduct those auto expenses. Others include property that you own or equipment that you own, and also continuing education courses.
So then for people who aren't included in that, I mean, what does the process look like for calculating a home office deduction?
Right, so I think that's a really big question for a lot of people because they're like, oh, I use this little space over here in my room for my business. How do I go about figuring out what I can deduct? So there are two options. You can go with the simplified option, and that's where you deduct $5 per square foot of the portion of the home that's used for the business, and that's up to 300 square feet. Or you can go with the regular method, which often can result in a larger deduction. So you determine the percentage of your home's floor space that you use for your business, and then you apply that percentage to eligible expenses such as mortgage, your rent, utilities. You can also change the method you use from one year to the next, so you're not tied down to one.
All right, fantastic stuff. Thank you for breaking that down for us. I know a lot of people have questions. Jana Heron there for us. Thanks so much. All right, hard landing, soft landing, recession, any way you slice it and whatever you call it, global growth is expected to slow this year. From the OECD, we're seeing the World Bank and now the IMF saying the doom and gloom is far and wide. The International Monetary Fund has trimmed its growth forecast for this year, and even though it predicts inflation will come down, it's still elevated. To discuss the IMF's World Economic Outlook, let's get to Yahoo Finance's Jennifer Schonberger. Hey, Jennifer.
Thanks, Rochelle. I want to welcome back to the program Chief Economist of the IMF, Pierre-Olivier Grinches. Sir, welcome back. It's great to see you.
It's great to see you, Jennifer.
So to kick off the conversation, how have the recent bank failures in both the U.S. and Europe impacted your outlook for growth? What is the risk that the global economy is teetering on the edge of recession?
Well, it's impacting us in forecasting a number of ways. I mean, first, we have our baseline forecast, which predicts that growth will be low at 2.8%, and then will be gradually increasing. And that forecast already takes into account that there might be some tightening of financial conditions, some contraction in lending in some economies. Then we do a separate calculation where we say, well, what if the contraction in lending turns out to be more severe? And we run our models, and then we come out and we say, well, that's still a fairly likely scenario, but now growth would only be about 2.5%. That's still a situation where financial instability is contained. We don't have a financial crisis. Then there's a third scenario, that's sort of like the gloomiest scenario, where we say, well, what if that cannot be contained? We have a full-blown financial crisis. We have capital flowing back from emerging economies to the U.S. treasuries. We have the dollar appreciating. We have all kinds of risk assets collapsing. And then we have the growth for the global economy would plummet to about 1% this year. Now, that's, of course, an extreme scenario. We estimate the probability of such a low growth rate is about 15%. So it's still relatively low, but we wanted to sort of cover the range of outcomes that are possible here.
Pierre, how would you characterize global stability right now? Do you think that these bank failures are isolated, or they are a harbinger of more challenges, tighter credit conditions to come? Is there contagion risk here?
Well, certainly the markets have been quite nervous in the last few weeks, and the financial sector has been severely tested by the increase in interest rates we've had in the last year, and that has generated losses for banks' balance sheets and non-banks as well, as we saw last fall, and also increased funding costs for banks as they're now, depositors are looking at how much they're earning on their deposit account, their savings account, and they're asking maybe, well, we should get a little bit more. And so that is a concern going forward. Now, the good news is that the banking sector in particular is in much better health overall now than it was at the time, say, of the global financial crisis. There's a lot more capital. The banks are better regulated. There are all kinds of liquidity requirements, et cetera, especially for large banks. And so overall, the health of the banking sector is much stronger. But it doesn't mean that there couldn't be pockets of illiquidity, pockets of vulnerabilities, and financial authorities need to be quite careful and monitor this because things could spread pretty quickly.
Yeah, well, to your point, how should central banks sort of walk this tightrope between managing inflation risk and the potential for credit tightening or liquidity issues? Do you think they should take a step back like the Bank of Australia did, sort of pause and see, or continue on their way?
At this point, we don't think they should take a step back. I mean, first, let's realize that most advanced economies' central bank may already be near the peak of their hiking cycle. So a lot has already been done, and then we should see the effect of that in the coming month and in the rest of the year. So there isn't really any indication that central banks would need to hike massively from where they are right now. Of course, there's always a risk that inflation might be a bit more persistent, but even then, I don't think anyone is anticipating a very, very sharp increase in policy rates. But having said that, the second factor to take into account is this financial fragility is going to lead probably the banks to be a little bit more cautious in extended lending. And so they are going to contract lending going forward. How much is still to be determined. We don't know quite yet. But that's also going to weigh down on activity. That's going to cool off the economy, bring down inflation. And what that means is that central banks don't need to do as much because the lending sector is going to be doing some of it for them. But what's really important at this point is that central banks should not veer away from the fight against inflation for financial stability reasons. We don't think that would be appropriate. There are other tools that are available to financial authorities that need to address localized pockets of vulnerability, and that doesn't require adjusting the policy rates or giving up on the fight against inflation.
Pierre, you see inflation coming down this year, headline inflation, I should say, to 7% from 8.7% last year. As you estimate, oil prices are expected to drop by 24%. I'm curious how you're factoring into that OPEC's recent oil cuts announcement. What makes you think that we're going to see oil prices come down that much and the impact that we could see on inflation? Is demand going to cool that much?
Well, so first, the recent announcement by OPEC that they were planning to cut production for the rest of the year, I should be clear that this came after we'd already closed our round of projections. So this is not, that announcement is not reflected in our projections. And what we can see is, OPEC is announcing that they're cutting production by roughly 1% of world production. And we've seen the price of oil going up by about 8% in the days following that announcement. So certainly this is increasing the price of energy. This is going to feed into the consumer price index. This is certainly not going to help inflation coming down. I mean, we see this effect as relatively modest right now, but certainly going in the direction of making inflation more persistent and requiring more action on the side of central banks going forward.
Pierre, you're there on the ground at HQ for IMF World Bank spring meetings. What are you hearing? What is the topic of discussion? Is it the bank failures? Is it inflation? What is top of mind?
Well, there are a number of topics that you can imagine. We have a gathering of most authorities from our membership here during the World Bank and IMF spring meetings. Obviously, questions around financial stability, questions about risks to the banking system and the non-banks, that's certainly top of mind. Lots of discussions about how to deal with the debt crisis for many highly indebted countries that are in situations of debt distress. That's something that certainly has been a concern for some time now, and the fund is certainly hoping, in conjunction with its partners, to make progress on this front. And then there are broader topics like climate change and how to engage in this and how to mobilize multilateral development banks and the role of the IMF in that context. So lots of big questions that we're tackling this week at the IMF World Bank spring meetings.
Well, we'll be watching closely, Pierre. Thank you so much for your insight. I so appreciate it. Hope to speak with you again soon.
You're welcome. Thank you, Jennifer.
That's Pierre-Olivier Gourinchas, Chief Economist of the IMF. Rochelle?
All right, thank you, Jennifer. Well, before we go, let's get your final check of the markets as we head into the noon hour. A mixed picture here. Only the Nasdaq in negative territory so far. We see the Dow there up about 120 points on the day, actually near its session highs. The S&P there up just slightly, though, just barely there, almost about 2.5 points there on the day, being weighed down by tech at the moment, sectors-wise, and utilities as well. Core CPI and PPI, retail sales, consumer sentiment, all on deck this week. Still being dragged down, though, by the Nasdaq. As you can see, they're down about 0.5% on the day, but we are seeing that Bitcoin having a bit of a rally today, up 6% as they wait for more of this economic data to come out. Well, that'll do it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern. See you then.